Very good morning, friends. So I hope everybody is doing good. And I hope you have also made a revision of what we studied in the last class. Well, we were talking in terms of Index 28 that deals with accounting for investment in associate as well as joint venture. And in the previous class, we have discussed mainly, you can say, two typical issues. I made a list of 5 issues with you. And out of that, I have covered already 2 issues with you. One is with reference to when does Index 28 get triggered? And we typically saw 2 situations that once you establish the relationship of a significant influence, or you establish the relationship of a joint control, and it turns out to be a joint venture as per Index 111, then we need to apply the accounting of Ind AS 28 in the consolidated financial statements. Index 28 tells us the method called equity method, and we use this one-line consolidation in terms of presenting the investment in the consolidated financial statements of the investor. Then I'd also given you the inputs with regard to the cases that is the standard something which is mandatory, or are there some exemptions or exceptions available for consolidation? And I'd given you the inputs that in terms of the exemptions, we discussed the concept of para number 17, 18, as well as 19. Para number 17, to remind you, was typically dealing with the similar kind of case which is there in Index 110, wherein we saw that once you meet the 4 conditions which are quite similar to the para number 4 of Index 110, then you get an exemption, which means you get a choice of not applying an equity method. Then I gave you the second case where it was a situation of para number 18, where we saw that we may have a direct as well as you can say a direct or an indirect percentage, which is held through either you can say you are directly a VCO, venture capital organization, or a mutual fund, or maybe a unit trust or similar entity, or you are holding the investment through a subsidiary, and the subsidiary is either a VCO, mutual fund, or unit trust, or a similar entity, then in that particular case also you get an exemption. And there itself, I had also given you a situation where the exemption would turn into an exception. And we saw the situation that if it is supposed to be an investment entity, that means, let's say, for example, as a parent, you are an investment entity also, and you qualify for the exemption, rather I would say the exceptions under Index 110, then you need to mandatorily take the exception under Index 28 as well. So if the status is of an investment entity and a venture capital organization, then you would be mandated not to apply Index 28. Then I give you the third aspect in terms of the exemption number 3 in para number 19, which was a case of either direct plus indirect, or maybe just indirect. But one of the portions of the indirect investment is held through a VCO, mutual fund, unit trust, or a similar entity, in which case you get an exemption only for a portion of the investment, irrespective that individual portion qualifies for a significant influence on a standalone basis or not. Then I also give you little inputs in terms of how the equity method is to be applied, but though we yet to discuss in a little more detail and take you to some practical illustrations on the equity method of accounting. But I think before we take the journey forward, I had given you a few MCQs in the last class, so I think I'm going to first answer those MCQs to you. Then I'm going to come to the detail on the accounting by an equity method, which is called a one-line consolidation. So I think let's begin the journey in terms of the MCQ questions which I gave you. The first question which I gave you is that significant influence may not exist even if the voting power percentage is more than 20% or equal to 20%. And I think we've already seen that it is supposed to be not a rule-based assessment, but a principle-based assessment. And in this particular case, we decided, and that's rightly said, the statement in this particular case is supposed to be, just missed that. So the statement in this particular case is it may not exist. So it is true. I think I'm getting an answer which is false for the first one. I think I got true and false both. Okay, I think rectified. Shalinder, I think you said false. I'm afraid it's going to be true because it may not exist even if the percentage is more than 20, principle-based assessment. So the answer for one is true. The second one says significant influence implies a mandatory application of Indes 28. That means if you establish a significant influence, then we get no exceptions, we get no exemptions, but that's not true. So the second one is going to be false, and that is absolutely correct. Then there is a third one. There are three cases where exemption, that is the option, is given to the investor to apply Indes 28. And I think, yes, we've got three exemptions, as I just discussed. The para number 17, the para number 18, and the para number 19 gives you the three cases of exemptions, though one of the cases may turn into an exception. But yes, the third one is absolutely true in nature. And that's right, Rashmi, absolutely correct. Then the fourth one I gave you, that there are no exceptions. There are no exceptions to Indes 28. I think this was one question which I said, for those who have attended this particular last lecture would be in a very comfortable position to answer that yes, there is one particular exception, especially when you become an investment entity and a venture capital organization. So this is supposed to be false in nature. So the fourth one is false because there are exceptions. And finally, we got the fifth one. At any point of time, investment in a consolidated financials as per the equity method is always equal to the share in the net assets plus the amount of goodwill, which is computed on acquisition date. So when you are going to represent the investment in the consolidated financials, you will always see that the value of the investment is equal to the net asset share plus the goodwill on acquisition date. Absolutely true in nature. That's absolutely correct. Okay, so I think that was pretty simple and straight indeed. So we are done with this particular part. Now I am going to take it further. Okay, now we're going to go to the third area of discussion with you, which is a complete practical application of this particular index. I've given you a little flavor in terms of this, but I think now we're going to do some questions with you. But before that, let me just, I think, give you a brief once again on the accounting part. So I think, let me just remind you that when you're applying the equity method, so you can maybe take down the notes as well. So when you're applying the equity method of consolidation under Indes 28, I gave you a very simple concept, and that is the first thing is, what do you do on the date of acquisition? On the date of acquisition, you need to compare the cost of acquisition, the cost at which the investment is acquired, and that is to be compared with the share in net assets of the associate or a JV. And those net assets need to be, remember, at a fair value, not a book value. So it's quite a similar exercise. What you do under Indes 103 as well, a similar kind of exercise needs to be done out here. You need to compare the cost of the investment versus the share in the net assets at a fair value, and which is on date of acquisition. So you can see the two focus words very clear. That you need the net assets at a fair value, that's one, and on the date of acquisition, that's two. You compare the cost and you get the amount of goodwill or capital reserve. So this difference is going to give you a goodwill or it's going to give you a capital reserve. Now, another important thing, what you need to keep in mind, unlike you can say in terms of Indes 110, where you consolidate and this goodwill or capital reserve is supposed to appear as a separate line item, this goodwill capital reserve in terms of Indes 28 does not appear as a separate line item in the balance sheet of the company, but it is included as a part of the carrying value of the investment. Mind the words carefully. So this goodwill is going to be included. This is going to be included, you can say, as a part of the carrying value of investment in the consolidated balance sheet. So this is not going to appear as a separate line item, but it is going to be shown as a part of the carrying value of the investment, which means if you recall that the value of investment in the separate financials and in the consolidated financials on the date of acquisition will be of an equal amount. So let's say, for example, if you have acquired an investment at 20 lakh rupees, then you can say that if I were to make the separate financial statements or the consolidated financials on the date of acquisition, the value of the investment in both the financials would appear at 20 lakhs, but that's true only for a date of acquisition. Now, this is the first stage when you're looking at the date of acquisition. Then comes the second stage, and that is, we can say, is the post-acquisition changes. Then we start looking at the post-acquisition changes in the equity, or you can say the net assets of the associate. So in the post-acquisition changes, the focus is that you need to focus on the equity, or you can say the net assets of the associate or the joint venture entity. Which means you need to now continuously look at the movement of equity of the associate. Now, the rule is simple, which I gave you, that on one hand, you've got the equity of the associate or JV, and the other hand, you've got the investment in the books of the investor. Trust me, they're going to flow in the same direction. They're going to flow in the same direction. If the equity of the associate or JV moves up, then the value of the investment also moves up, but it will move up only to the extent of share in that increase, not the entire increase. Similarly, if you can say that the equity or the net assets of the associate or JV moves down, the value of the investment will also move down to the extent of share in that decrease. So the rule is going to be very simple. When you're looking at a post-acquisition changes, you're going to focus on the equity or the net assets of the associate and JV. If they increase, then you need to increase the value of the investment as well. That means you need to make a debit to the investment. But this debit to the investment is only to the extent of share in that increase. If the equity or net assets goes down, you need to take a corresponding effect on the investment, and the investment will decrease. That means you're going to give a credit to the investment, and that is also to the extent of share in that decrease as well. So now the important input is that when you're taking the impact of the equity on the investment, either you debit or credit the investment, the question arises, where will you take a corresponding credit? Or where will you take a corresponding debit in the books of accounts? The rule is simple. You need to see that the equity of the associate is taking a corresponding credit where? If the associate credits the profit and loss, then you would also, as an investor, give credit to the P&L. So if he gives a credit, let's say, to the other comprehensive income, then we will also give a credit to the other comprehensive income. If he gives a credit directly in terms of SOKI, that is equity, we also need to give a credit corresponding to the equity itself. So the debits and credits is going to be either in the profit and loss or the other comprehensive income or the equity. You just need to look at the impact that when the associate or JV recorded the particular transaction, which is a post-acquisition change, did it impact the profit and loss or the OCI portion, or did it directly was taken to equity? Correspondingly, the investor is supposed to take the same credits or debits itself. The rest, I think, we'll explain with a practical illustration to you. So I think there are two stages now which we need to keep in mind as you're going to do the accounting of investment in an associate. The stage one is on the acquisition date, where the focus is in terms of calculating a goodwill or a capital reserve, which is a part of the carrying value of the investment and not reflected as a separate line item. And the second stage of accounting is the post-acquisition changes, wherein the change in the net assets or equity of the investee, that is associate or JV, decides the accounting in the books of investor. Increase in equity I would debit the investment. Decrease in equity, I would credit the investment, number one, to the extent of the share. And number two, the corresponding debits or credits would be either P&L or OCI or directly equity, as the case might be. I hope I'm pretty clear on this accounting. So let's do one thing. Let's now take you to a small little practical illustration where we're going to see the application of the equity method with you. So let's, I think, take it further. So I am, first of all, coming to the study material. And in the study material, if you look at the page number 14.149, where we're given the index 28, I am looking in terms of illustration number 8. Now, as we read this particular illustration, we're going to correspondingly keep thinking about the impact on the associate's equity or the JV's equity, whatever the case might be. It says on the first day of a financial year, A invested in the equity share capital of B at a cost of 1 lakh to acquire a 25% share in the voting power of B. A concluded that B is an associate of A. Then he says at the end of the year. Now, in this particular case, we are not given any information where I would be able to identify the goodwill or the capital reserve at the date of acquisition, because we are not given the status of what is the equity or the net assets on acquisition date. So we may not be able to identify the goodwill. The focus of this particular question is on the post-acquisition changes and not on the goodwill calculations. Otherwise, just to give you a reference, I should have technically seen that what is the equity on the date of acquisition of the associate company B and compare that with 1 lakh rupees, whatever is the share in the equity, and you would get a goodwill capital reserve. But anyway, the data is not there. Then it says, we are given further, A is concluded that B is an associate of A at the end of the year. Now, this is a post-acquisition changes coming. B earned a profit of 10,000. Now, when I say that it earned a profit of 10,000 and other comprehensive income of 2,000, it means that there is a profit in the profit and loss section of the income statement. And there is a OCI income in the profit and loss section. So the company is earned a total profit of 12,000. And out of the 12,000, 10,000 is earned in the P&L section. And 2,000 is earned in the OCI section. So the moment the associate company earns a profit, the equity of the associate or the JV will go up. So what do I need to do? I need to recognize my share in that increase. So out of 10,000, 25% would mean 2,500. So what do? I will give a debit to the investment, and the corresponding credit will be given to the P&L because the associate company got a credit in the P&L. So we will also give a corresponding credit in the P&L. Then for the 2,000, which is taken in the OCI, we can say out of 2,000, 25%, that is 500, belongs to the investor. So we can say the entry is going to be investment debit, and the corresponding credit is going to be given to the other comprehensive income because this is a credit in the OCI for the associate. So the investor also takes the same line of credit. Then he says in that year, B also declared a dividend to the extent of 4,000. Now, in this particular case, we can say the moment the company would declare and pay a dividend, the equity of the associate or JV will fall down. So we need to also decrease the value of the investment. So we need to give a credit to the investment account. So where do we give a corresponding debit in this particular case? So let's say, for example, if you receive the dividend, then you can take the entry bank account debit. Okay, so I think let's see necessary entries in the books of A to account for the investment in associate. And I think let me caution you again that these entries which we are passing is not in the separate financial statements. These entries are being done with reference to the consolidated financial statements. So we can see the entries, and I think I'll just make a walkthrough instead of writing those entry. We can see the first entry when the investment was done. The entry is investment debit, and the bank is given a credit, which is to the extent of 1 lakh rupee. Then the post-acquisition changes, you can see the first entry, investment gets a debit and the profit and loss gets a credit. 10,000 into 25%. The third entry you can see is investment account debit, and we've given a credit to the OCI, which is gain on 2,025%. And then the third entry, where we're recording the dividends, so dividend receivable, and the investment is given a credit, which is again 4,000 into 25%. As simple as that. So we can see that in this particular case, we can say that what we have done, we are just simply going with the corresponding movement of the associate's equity. So its equity moves up, investment debit. Equity goes down, investment credit. And the other corresponding credit or debit is simply to the OCI, or you can say to the P&L or to the equity. As simple as that. I guess we would be pretty comfortable and clear on this. Okay. So now I think, let me just take it further. We can perhaps also go to another small little question with you. I'm going to take a small question with you, which is an examination question, I think, which I'm going to solve. So let's have a look at the question number 10A on your screen, which came for 5 marks in January 21 examination. Let's, I think, read this and we're going to solve it. It says on 1st April 2019, BIG acquired a 35% interest in DIG and achieved a significant influence. The cost of the investment is 3 lakhs and DIG has got net assets, which is 5,50,000 on 1st April 19. The fair value of those net assets is 650, since the fair value of the PPE is 1 lakh more than the book value. Now, you would remember that when I said you're going to calculate a goodwill, you need to compare the cost of the investment versus the share in the net assets at a fair value and not a book value. So I'm not going to consider the figure of 550 because that would be the book value portion, but we're going to compare it with the share in 650. Then he says this PPE has got a remaining life of 8 years, and for the financial year 1920, DIG earned a profit of 1 lakh post-tax. So this is a post-acquisition change, and it paid a dividend question with you. Okay, so let's, I think, start making a focus in terms of 2 things. Number 1, we're going to focus on the date of acquisition. Let's go step by step. It's pretty easy. So this is the January 21 examination question. And for this particular purpose, for the application of the equity method, I'm going to apply the 2 concepts. One is I'm looking at the status on the date of acquisition, wherein I just need to calculate the goodwill or the capital reserve. So let's compare the cost of the investment, and we're going to compare this with the share in net assets at fair value, and of course on the date of acquisition. So if I look at the data, the investment is acquired at a cost of 3 lakh rupee. So the cost of the investment is 3 lakh. And then we are given that the fair value of the net assets is 6,50,000. So we've got the net assets at a fair value is 6,50,000. And we've got a 35% stake in that company. So we get the share in the net assets. 6,50,000 into 35% would mean 227,500. So once you compare 3 lakhs versus this, you're going to get the amount of goodwill, and that comes to 72,500. So this is the amount of goodwill. And if you were to ask me what is the value at which investments would appear on the date of acquisition, that is on 1st April 19 itself, I would say it would appear at what figure? 3 lakh. And in the brackets, you will give a disclosure that this is including a goodwill of 72,500. So just for a little better understanding, let's say if I make a T-shaped consolidated balance sheet, then I would reflect the investments at 3 lakh rupees in the consolidated financials. And in the brackets, you will make a mention that this is including a goodwill calculated, which is 72,500. This is not going to appear as a separate line item. Stage 1 is done. Now let's go to the stage number 2. Now we are looking at the post-acquisition changes. Now we're looking at the post-acquisition changes. Now a little caution, which was not there in the previous question, but now a little caution. So I'm going to consider the base as the investment value. The 3 lakh rupees which we have taken as the cost of the investment is taken as a base. Now we just need to consider the movements of the changes. Let's have a look back. It says, first of all, that for the financial year 1920, DIG earned a profit after tax, which is 1 lakh rupee. Now, caution friends. Now, one thing is very clear, that if the associate company earned a profit after tax, the equity went up. So I also need to debit the investment. So what I'm going to do, I'm going to increase the value of the investment to the extent of share in the profit after tax for the current year. But when you're going to consider the increase in the share in the profits, remember, you are not going to consider the book profits in this particular case. You cannot consider the book profits in this particular case. Reason why. Now let's come back to the question and let's understand. We are very clearly given that on the date of acquisition, the company had a fair value of the net assets, which was 650. As compared to the book value, which was 550. And this is due to the fact that a PPE had a fair value 1 lakh rupees more than the book value. Now, this increase would not have been recorded in the standalone statements of the associate. The associate company would not have taken a revaluation of this asset in its own standalone financials. So the profits computed by the associate company is without incorporating this fair value increase. Now, since for the purpose of consolidation, you've already considered the PPE at a fair value, remember, you need to convert this book profit and consider the impact of additional depreciation as well. So you need to consider that if this revaluation would have been incorporated in the standalone statements of DIG, in that particular case, he would have taken a depreciation based on a fair value rather than a book value. So whenever there will be a revaluation increase or decrease in the assets, you'll have to convert the book profits and incorporate the additional depreciation or incorporate the excess depreciation. I'm very carefully using my words, because if there was an upward revaluation, then there will be a need to consider additional depreciation. And if there would have been a downward revaluation, there will be a need to add back the excess depreciation. So remember that when you're going to consider the share in the book, share in the profits, you need to translate this PAT from book profits and incorporate any additional depreciations or reverse any excess depreciation. So we are very clearly given in the question that the profits earned in the current year is 1 lakh rupee. That is the book profits. We need to reduce the amount of additional depreciation from this. Now let's consider what is the additional depreciation. Now in this particular case, we are given that the asset was revalued 1 lakh more than the book value. And we know that when there is a revaluation, the depreciation changes on a prospective basis. We given the remaining life of the asset is 8 years. So 1 lakh rupees will be divided by the remaining life, that is 8. It comes to 12,500 is the additional depreciation. So once you make a reduction of this amount, then you will consider the share in this rectified profit. So I think the focus point is that you need to get the rectified profits for this. So if I consider 1 lakh rupee minus 12,500 and take a 35% share, it comes to 30625. So this is one important focus point. And whenever you see that there will be an assets taken at a revalued figure, you need to be cautious. Additional depreciation, excess depreciations, as the case might be. Let's see more movements. Then it says that the company is also paid dividends out of these profits. Now, naturally, if the company paid dividends, the profits, the equity went down. And if the equity went down, you need to reduce the value of the investments. So we're going to reduce the investment, so minus. So we're going to reduce the amount of dividends because that would reduce the equity of the associate company. And the dividends which have been paid is to the extent of 11,000. So on that 11,000, you're going to take a 35% share. Everything is to be taken based on the share. 11,000 into 35%, that comes to 3850. And then I think finally there is one more information which is given. And then he adds on that D also recognize a loss in the other comprehensive income, which is 15,000. A loss would mean that the equity of the associate went down. So you need to also reduce the value of the investment. So let's take the share in the other comprehensive income. And that's to the extent of 15,000 into 35% is the share of the investor. So 15,000 into 35%, that's 5250. And I think that's it. So this will give us the value of the investments, which would appear at the end of the year. So this is on 31st March 20. So when you're going to make a consolidated financial statements at the end of the year, the value of the investment would appear at this figure. So 3 lakh rupees plus 30625 minus 3850 minus 5250. So this is coming to, I guess, 321,525. This is the value of the investment. So we will reflect the value of the investment at this figure and make a mention that this is including the goodwill, which was identified earlier. Wow. I hope, friends, I am pretty clear on the application of this particular method. Okay, I think Koshki, you said, will we do the tax adjustment in the PAD? Well, since it is already after tax, no adjustments required in this particular case. No adjustments are required. Okay, and this is done. Now, I know what you might be thinking of, but I think you're not going to see that in any of the questions. Are you indirectly thinking that, because of this additional depreciations, there could be some deferred tax implications, etc.? I think I'm not thinking on those lines at the moment. Okay, so this is done. This was quite a basic illustration indeed. I think let's do a little complicated question with you. I think we fairly understood the application of the equity method. It's a two-stage accounting. One is you identify the goodwill or capital reserve on the acquisition date. Second is you look at the post-acquisition changes and do the accounting. So let's, I think, go to a little more complicated question with you, which is one of the questions in the study mat as well. So I think let's have a look at another small little question with you. This is quite a similar question which we did right now. Then I think after illustration 10, I'll probably take you to another illustration. But before that, we'll give you one or two clarifications before we go to a complicated question with you. Now let's have a look at the illustration number 10. It says Blue acquired, this is study material illustration 10 on page number 14.153. It says Blue acquired a 25% equity share capital of Green on the first day of the financial year 1,25,000. As on that date, the carrying value of the net assets is 3 lakh and the fair value is 4 lakh. I'm not concerned with the book value, the carrying value. I'm concerned with the fair value. So we can see that if we compare 4 lakhs into 25%, that works out at 1 lakh rupee. So the cost of the investment is 125, and I think you can mentally calculate the share in the net assets at a fair value is 1 lakh rupee. So if you compare the two, we get a goodwill of 25,000, and I think you can see that in the solution very clear. Comparing 125 versus the share in 4 lakh, that's 25,000 goodwill, and you can see a note which is given below the chart. The above goodwill is recorded as a part of the carrying value of the investment. Great. Next. This is the excess of the fair value over the carrying value to one of the buildings has got a remaining life of 20 years. So this increase of 1 lakh rupee is attributed to the fair valuation of the asset. Immediately what comes to the mind is additional depreciation. So 1 lakh rupees spread over the remaining life of 20 years, we've got a depreciation of 5,000 rupees. Then he says Green earned a profit of 40,000 and an OCI of 10,000. You need to calculate a goodwill capital reserve on acquisition date, done. And Blue share in the profits and OCI for the year ended and get the closing value of the investment. So I think, as I just said, I Generally, what I do is, and I would insist that you should take the share in the rectified profit. So instead of considering the share in 40,000, I would say, why not reduce the additional depreciation of 5,000 and consider 25% of the 35,000. Comes to the same things, what you can see. The share in the profits has been taken, and then the adjustment for depreciation is made. You can even do it the way I do, that from 40,000, you reduce the additional depreciation of 5,000, take a 25%, it comes to the same figure, 8,750. So I think that would be easy to keep a track, that you need to take the share in the rectified profits always. And then in terms of OCI, we take a 25% share again. So you can see the calculation of the investment value for the consolidation. We've taken 125 as a base, added the share in the profits, added the share in the OCI, and you get the carrying value of investment. Very simple, very straight indeed. Wow. Okay, so this part is done, and I hope you're absolutely clear with these calculations as well. Now, before we take it further, I think let me give you one or two simple clarifications now on the equity method of accounting. So I'm just giving you a few clarifications based on one or two inputs which are given in the study material and one or two inputs which are given in the education material on Index 28. Number one, the first clarification which I want to give you, let's say a company is required to make some mandatory transfer to reserves. Let's say, for example, we are given that a company is required to make some mandatory transfer to reserves. Like, for example, the law may require you to push an amount in case of redemption of debentures to DRR. So the question rises that if the associate or a JV company is required to make a mandatory transfer reserve, do you consider the profit after tax minus this mandatory transfer in order to apply an equity method, or do you consider the PAT without the mandatory transfer? Well, the education material has very clearly said that we do not consider this mandatory transfer into account. So in this particular case, I will simply take the profit after tax of the investee company and I will take the share. We are not supposed to make any reduction of this mandatory transfer. We need to consider the profits which is attributable to the, you can say, shareholders. And when you use the word attributable, then any kind of mandatory transfer reserve not to be taken. That's one. Second, let's say, for example, the associate company has got certain cumulative. Let's say they've got certain cumulative preference shares, but these cumulative preference shares are supposed to be held by outsiders. So these cumulative preference shares are held by outsiders. That means the associate or the JV company has also issued certain preference shares which are cumulative in nature and which are held by outsiders. The question arises, when you consider the share in the PAT, do you multiply the share in the PAT, or am I supposed to reduce the preference dividend as well? The clarification given is that you are required to reduce the preference dividend as well. So we will first of all calculate the profits which is available after the payment of this preference dividend on cumulative preference share. And then whatever is the net profit, we would calculate the investor share in that net figure. So these are two small little clarifications to give you, that you need to consider the dividend on cumulative preference shares, but you're not required to consider any mandatory transfer to reserve. So on this particular aspect, there is a small little illustration also which is devoted. So let's have a look at the illustration number 11, which is based on the clarification which I just gave you. It says in illustration 11, KL has invested a 50% voting power of a JV, that is MN. MN has also issued a 10% cumulative shares to other investors, outsiders, and which is for 10 lakh rupees. And during the year, MN earned a profit of 4 lakh. MN has not declared any dividend on the preference shares for the current year, but I think you know this even in terms of EPS, Index 33, that in terms of cumulative preference share, it doesn't make a difference whether dividends have been declared or not. So in this particular case, since it is cumulative in nature, Irrespective, the dividend has been provided, declared in the books of accounts or not, doesn't make a difference. So when you go to consider the share of the investor, we will consider the profits, which is 4 lakh minus a dividend on 10 lakhs at 10%. So we will take the profits, which is attributable. And as you can see, that we're very clearly given that in this case, the net profit, which is attributable to the equity shareholders. So on that 3 lakhs, you take a 50% share. So the entry for equity method is going to be based on 1 lakh 50. Simple and straight. Okay, so I think this is pretty simple and straight indeed. Okay, now I think I'm going to take it further. Now we're going to do a slightly more complicated question. And Kosh, you said, what do you mean by outsiders? Outsiders in the sense that this is the investment which is not held by the, you can say, investor. The investor doesn't have those equity shares. It is held by other than the investor. So in this particular example, we can say, if I just go back to the illustration 11, we can say KL is the investor. So these preference shares are not held by KL, but it is held by somebody else. That's what we say outsider, not the investor, other than the investor, right? Okay, now I think we're going to go to a little more complicated illustration with you, which is illustration 12. It's not very tough, but it is a good illustration. It's a little blend in terms of your concepts on Indes 110 and then the application of Indes 28 on that. Let me, I think, first read the illustration with you. Now, very carefully read the facts of the illustration with me. It says entity A has got a 20% equity interest in B as an associate. That in turn has got a 100% equity interest in C. I think, let me just draw the diagram also so that we are absolutely clear on the agenda. So if I look at the facts, what are given in this illustration, that is illustration number 12. Let me first of all diagrammatically have a view. A has got a 20% stake in B. So A has got a 20% stake in B. This implies a significant influence. So B is an associate of A. Then he says that in turn has got a 100% equity interest in C. B has got a 100% equity interest in C. This means it is a case of control. So C is supposed to be a subsidiary of A. Wow. So this is, you can say, a subsidiary of an associate company. Now, let's go further. It says entity B recognize the net assets relating to entity C, 1,000 in consolidated financial statements. Now, what entity B did, it sold a 20% interest in C to a third party, a non-controlling interest holder. Now, let's remind us one thing. Now, in this particular case, we are given the facts very carefully. Have a look at this. The company B sold a 20% stake. The company B sold a 20% stake, but what happens? It had a 100% stake in C, and by a sale, it has still got an 80% stake in C. There is a change in the ownership percentage, but the control is not lost. Mind the words carefully. You've already seen in the application of Indes 110 that in this particular case, there is no loss of control. The control continues in this particular case. And when we say that there is no loss of control, it only tantamounts to a change in the equity, in the change in the NCI. So in this particular case, if you recall, the entry which you're going to do in the consolidated financial statements, the entry B will do in the consolidated financials, he's going to put the entry bank account will be given a debit to the extent of 20% sale proceeds. And we are going to give a corresponding credit to NCI. And if there is any balancing figure, that is going to be taken directly to equity. It's not taken to the P&L, it's not taken to the OCI, but it's taken directly to the equity. Now let's see the data. Then he says that entity B sold a 20% interest in C which is sold at 300, and recognize this transaction as an equity transaction in accordance with indas 110, resulting in a credit in B's equity 100. So what is the entry we did? We sold the 20% stake at 300. The NCI will be recorded at 20%. So 1,000 is the net assets of the C company, and the NCI gets created at 20% of that. So we get a balancing figure, which is a profit, and this is going to be taken directly in equity. That is so key. It's going to be taken directly in equity. This is what we do when there is a disposal where there is no loss of control. We do this entry in the consolidated financials, which means by doing this particular entry, what did the company B do? It basically gave a credit to equity. It basically gave a credit to equity. So now I think, let me tell you something. Can I say, if you look at now B's point of view, you can say because of this disposal, there is an increase in the equity of the associate. So A as an investor should debit the investment account, pretty sure. And he would pass an entry recognizing the share in that 100. But where will he give a corresponding credit? I think if you've understood my concept well, you can tell me. If the associate company B is giving a credit directly to equity, what do you think A is going to give a credit for the equity method of accounting? Your inputs in this case. Let's get your inputs in this case. Okay, I think Koshki, you said, can you tell why is it taken to equity? Well, this is considered as a transaction between the shareholders. And when there is a transaction between the shareholders, it cannot lead to a gain or loss, which you're going to recognize in the profit and loss statement. So in this particular case, the standard indas 110 is very clear that when a company is dealing into a transaction, which is a direct dealing with the shareholders of the company, it doesn't lead to a profit or loss, which is to be taken as a part of the P&L statement. It's a shareholders dealing directly with each other. So this is going to be a gain or loss, which will only affect the equity of the company without rooting it in the profit and loss. It should not impact the profits. It should not impact the EPS of the company. So my question, I think, still remains that if B as a company, which is an associate, gave a credit to the equity directly, so A as an investor would also increase the investment value. And where should he give a credit? As I've already said, that the credit is given on the same lines as the associate company. So let's see, what do you say? Where would the corresponding credit go? Bank? No. And that's right. You said investment debit bank. No. I think I'm yet to make my point. I'm saying that because of this particular transaction, you need to now look at the perception of A and B. This entry is done when B disposed a 20% stake in C. So B did the entry in its own books of accounts in the consolidated financials. Bank was given a debit, and the NCA was given a credit, and the equity was given a credit. Now, let me tell you again, please watch this carefully. This is B, one hand is B, and the other is the investor A. Now, this transaction resulted in increase in equity in the books of B, that is to the extent of 100. Agreed? Yes. Can I say, therefore, the investment should also get a debit? Yes. To the extent of share in that 100, 20%, that means 40. My question is, E would give a corresponding credit where? I'm looking at the entries in the books of A, mind it. When B did this entry of disposal and he gave a credit in terms of equity, what is the entry A should do as an investor? Can I say he should give investment a debit? Out of that 100, he can take a 20%. Where would he take a corresponding credit? Can I say he should take a corresponding credit directly to equity? Same lines as the associate company, right? Shalinder, you said a P&L. No. Rashmi, you're correct. Absolutely. Not P&L, not P&L. I think, friends, let me, stress this a little further. Let me stress this a little further. Now, you need to watch this very carefully. This is an important transaction. As I gave you a rule earlier, that you need to consider that this is an associate company. This is an associate company. Now I'm going to give you three transactions. Watch me carefully. I'll give you three transactions. Watch me carefully. And this is the investor. I'm going to give you three transactions. You need to tell me what is the impact on the associate. Now, watch it carefully. I'm going to give you three transactions. Watch it carefully. Number one, the associate company, let us say, considered a revaluation of a PPE, an upward revaluation of the PPE. So when the associate company did an upward revaluation of a PPE, where would the associate give a credit? Think very carefully in this case. Okay, now Navneet is also saying for A, it is profit and loss account. No. Just wait a minute. You'll get your answer. My first question is very clear that the associate company did a revaluation of a PPE, an upward revaluation. He would have applied IAS 16. So what would the associate give a credit to? Is it P&L? Is it OCI? Or is it going to be the equity? Think carefully. It's an upward revaluation of an asset done under IAS 16 by the associate company. So where would he give a credit to? P&L? Oh my God. When you did index 16, in terms of index 16, if you do an upward revaluation, where do you give the credit? Is it taken in the P&L or is it taken in the OCI? Remember the principles, what you did in index 16. If a company goes in for an upward revaluation of the asset, can I say you basically give a corresponding credit in the other comprehensive income, right? Correct. So the associate gave a credit to OCI. Where will the investor give a credit? He has to follow the same lines. He needs to follow the same lines. So he will also give a credit, investment debit to OCI credit. That's the point. You need to see where the associate gives a credit. The investor will give a credit at the same place. I hope I am very clear on the agenda. Let's give you another example. Let's say an associate company recorded a foreign exchange gain or loss, and that foreign exchange gain or loss is supposed to be a restatement of foreign currency transaction. There was a monetary item due to which a foreign exchange gain or loss is taken. So where do you think the associate company would have recorded in terms of Index 21? So you've got a foreign exchange gain or loss. So if you've got a foreign exchange gain or loss, then where would you record it in terms of Index 21? The associate company in its standalone financials, where would it take the gain or loss? P&L or OCI or equity? I'm not talking of that NIFO. But where do you take a foreign currency gain or loss in terms of restating the foreign currency transaction? Like, for example, you restated a debtors. Where is it taken? Is it taken in the P&L? Yes. It is undoubtedly taken in the P&L. So when they recorded a foreign exchange gain or loss, the asset company must have taken a debit credit to the P&L. So where would the investor take a debit or credit to P&L? Are you getting my point? Now I am coming to another inputs, friends, at this case. Let's consider the same transaction in illustration number 12, which we're doing. The company, that is the investee company, recorded a sale of a disposal of share. You sold a 20% stake you had in a subsidiary company. By virtue of Index 110, you gave a credit to equity. The associate company made a sale of investment in the subsidiary and they gave a credit of that profit to the equity directly. Where are the investor going to take a credit? Now this time you cannot go wrong. You need to follow the lines of the investee company itself. He credits, debits a P&L. You credit, debit a P&L. He credits, debits an OCI. You credit, debit an OCI. He credits, debits the OCI, the equity directly. So what is the corresponding things you're going to take it? Well, Okay, got the point clear. That's right, Rashmi, absolutely. I hope I'm very clear. I guess, Shalinder, you also got your inputs on that. The corresponding credit goes to equity. Can we test it further? Yes. So now let me say something, and I think you'll vouch me very clear. Does this mean that I should get a clarity in terms of which item as per which index is taken to P&L, OCI, or equity so that I can decide the fate of accounting in the books of investor? Yes. Let me give you one or two more transaction, friends, and you can tell me what would be the debit credit in the books of investor. Let's give you transaction one. Let's say there has been a rectification of a prior period error. There has been a rectification of a prior period error by the investee, that is associate or JV. What do you think the investee company will take the hit in its standalone financials? I guess you apply indas 8. So when there is going to be a rectification of a prior period error, would you like to tell me where do you take a corresponding hit? Is it P&L, is it OCI, or is it equity? Then I think you'll get the answer. If an associate company does a rectification of a prior period error in a post-acquisition period, what do you think as per indas 8, he's going to take a hit? Remember the points you've done in indas 8. I'm still waiting for your answers on that. Testing time. So the associate company rectifies an error, a prior period error. So where do you take the hit of a prior period error? Is it rectified in the P&L? Is it rectified in the OCI? Or is it rectified directly in equity? I guess I still didn't get answers. Oh my God. So where do you get the inputs on that? You rectify a prior period error. Can I say in equity, you restate the opening balance of the equity by virtue of indas 8, right? Am I making sense, friends? Then as an investor, if I were to consider the impact, where would I consider the impact? Directly in equity itself. You need to be very thorough in the movement that whatever the associate company does, if he takes a movement in the P&L, the investor takes it in the P&L. If he takes it in the OCI, he also takes it in OCI. If he takes it in the equity, he also takes it in equity. I hope I'm clear. The only thing which you need to be clear is that you need to be clear that as per which particular index, where do you take the corresponding hit to? Like prior period errors are taken a hit in terms of equity. So if there is any rectification of prior period errors, the corresponding impact by the investor would also go to the equity statement itself, right? I hope I'm pretty clear. Great. Okay, now let's come back to the question. I'm still reading the question with you. This is one of the questions which is given in the education material as well, and is given in the study material as well. And I think it came in one of the revisionary test papers as well. A very good illustration which clarifies that where does a corresponding credit or debit goes in the books of the investor. So let me read it once more. So it says entity A has got a 20% stake in B and B's got a 100% stake in C. B recognized the net assets of C 1000 in the console. B sold a 20% interest in C to a third party for 300 and recognizes this transaction as an equity transaction in accordance with indas 110. So I think I've already given you the inputs that what the company did when they made a sale of this investment. As per indas 110, this is the journal entry which must have been done in the books of, you can say, the company B, which is an associate of A. So company B did this entry in the consolidated financials. Bank was given a debit to the extent of sale proceeds. NCA was given a credit to the extent of share in the net assets. And the balancing figure gain loss is directly taken to equity. So now let's read it further. It says the financial statements of A and B before and after the transaction is given. Now, if you look at the consolidated financial statements of A, the consolidated financial statements of A is representing the equity at 200 and investment in B at 200. The logic is simple. The net assets of the company B is appearing at 1000 And we say that the investment always appears at the share in the net assets, and we are indirectly considering maybe there is no goodwill. So in this particular case, the investment is appearing at 200, which is 20% of 1,000. And correspondingly, the equity of A is appearing. If you look at the consolidated financials of B, there is a full consolidation. So B is reflecting the entire assets of C, and he's got an equity to the extent of 1,000. So this is the financials of A and B before B sold a 20% stake in C. Now, he has given you the movement in terms of B's financials, consolidated financials, after the entry is done. So all you need to do is you need to incorporate the entry bank, NCI, equity credit in the previous console. So if you notice in the previous console, there was just equity and the assets. Just incorporate the journal entry which I gave you. Bank got a debit of 300. NCA got a credit of 200 and the equity gets a credit of 100. So equity will become 1,100, as you can see. That 1,000 plus 100, it becomes 1,100. NCA is appearing at 200, and you can see the cash balance is appearing as a separate line item in the balance sheet. So basically, we've incorporated the entry, which I showed you, and this gives me the console of B. Although entity A did not participate in the transaction, entities A share of the net assets in B increased as a result of B's 20% interest. Now, if you look at the net assets of B, the net assets of B is to the extent of 1,100 as compared to 1,000 earlier. So in that 1,100, he's got a 20% stake in the company that works out at 220. So there is a increase of 20%, 20 rupees in its previous share. How is an equity transaction? He's saying that how does that equity transaction that is recognized in the financial statements of B reflected in the consolidated financials of A that uses an equity method to account for investment in B? So we can say that this transaction of a disposal resulted in increase in the equity of B, where he took a credit to equity directly, so key directly. So where would the investor give a corresponding credit to? Of course, he's going to give a credit to equity. So you can read the answer very clear. I'm just reading the last sentence of the question. And it says very clearly, thus in the given case, A recognizes 20 as a change in other equity instead of statement of profit and loss and maintains, read the language, maintains the same classification as an associate. Maintains the same classification as an associate. That is a direct credit to equity in the consolidated financial statements. I hope, friends, I am pretty much clear on this agenda, right? That's rightly given now. I guess everybody is now pretty clear. So I think I made my point that the only thing which you need to keep in mind in terms of the equity method application is two things. Associate JV equity up, investment up. Equity down, investment down to the extent of the share. That's one. And where is the corresponding debits, credits taken to? Can I now make a strong statement? And let's see if you can vouch me for that. The corresponding debits or credits will be either P&L or OCI or equity. Thank you. Is that correct? The corresponding debits or credits in the books of the investor, apart from the investment account, is going to be either P&L or OCI or equity. It all depends upon the classification category which is used by the associate company. The associate company gives a debit credit to P&L. I give a debit credit P&L. OCI, OCI, equity, equity. That's the name of the game, right? I hope I'm pretty clear on this now. Okay, so this takes care of my third inputs to you, which is the case of equity method of application of accounting. I think I've given you a fair good idea on that. Okay, now we're going to go to the next section of discussion with you. And the next section of discussion is in terms of what we call other long-term interest. Now, this is slightly a very interesting section. So watch this very carefully, because this is going to be slightly technical in nature. But I think I want to first take this before I go to the concept of any changes in ownership interest. So let me, I think, now take you to the study mat. And in the study material, apart from some upstream, downstream transaction discussions, there is a very interesting input which is given in the standard, and it is given in the, you can say, the appendix to Index 28. And I think I would like to now show you something. Now watch this carefully. The next almost half an hour is going to be quite crucial indeed, because this is a concept which you will either understand very easily, and trust me, you're going to understand this very easily. Terms and conditions apply. So I'm now just going to take you to a very interesting concept that's called a long-term interest in associate or JV apart from the equity investment. Let me first of all give you a chain of thought. Sorry. Let me first of all give you a very important chain of thought on the basis of which we're going to take a journey forward. Now, for the purpose of Index 28, that is equity method of accounting, my mind is working on a total of 4 cases. You know, if you ask me, I would say that there are typically, you can say, 4 cases which you can confront in the equity method application. What we're doing right now is an extension of the equity method of accounting only. Now, there could be a case number 1. Let us say as an investor, you have only equity shares in the investee company. I'm using the word investee because investee could be associate or a JV. So as an investor, you can have only equity shares in the investee, or there could be a case number 2. And you can say that as an investor, you have not only equity shares, but there are certain other investments. So apart from the equity shares in the company, you've got other long-term interest as well. You've got other long-term interest as well. And this long-term interest could be, for example, in the form of, let's say, preference shares in a company. Let's say, for example, it could be long-term loans in that particular company. So we can say that there could be certain other stake in the associate company as well. The investor may have some other long-term interest. The word is very clear, long-term interest. When I say long-term interest, it doesn't mean a trade receivable. It basically means those kind of investments which are similar to the concept of NIFO under Index 21. The investor has given a long-term loan to the associate company, and we can say that there is neither any intention to ask for a repayment of that loan, nor it has been planned. So remember, you've done a similar kind of concept in terms of Index 21, where we consider that if a company, you know, as a parent company, you've certain long-term interest in the associate company, which is as good as equity. Because if you've given a loan to the asset company, you've got no intentions to recover that money. Neither any dates has been planned, nor any intentions are there. So that is called a long-term investment. So there can be 2 broad cases, that as an investor, you've got only equity shares, or as an investor, you've got other long-term interest as well. Now, each of these cases, there can be 2 situations. And what are those 2 situations? The situation number 1 is that the associate company is a profit-making company. The associate company is a profit-making company. If you would have noticed, the illustrations which I did with you on the equity method, you could see that the associate company is just earning a profits in the post-acquisition period. And such kind of a question does not give you any kind of challenges. But the problem comes if the associate company is a loss-making company. Now, let me, I think, go to the situation 2, because situation 1 we have already done. And you know that if the associate company is earning a profit, you need to debit the investment. So that we've already seen. Now, let's, I think, talk about the situation number 2. Now, imagine that your investment was bought at a cost of, let's say, 2 lakh. The investor bought the investment, let's say, at 2 lakh rupees. And when you calculate the share in the post-acquisition losses, When you calculate the share in the post-acquisition losses of the associate company, you realize that the share in the post-acquisition loss is 3 lakh. The share in the post-acquisition loss itself is more than the cost of the investment. The question arises, how would I reflect the investment in the balance sheet? Well, in this particular case, you will have to reflect the investment in the balance sheet at a zero value. You'll have to reflect the investment at a zero value, because from 2 lakh rupees, if you reduce 3 lakh, it becomes minus 1 lakh. You cannot reflect the investment at minus 1 lakh in the balance sheet of the company. So you will basically show the investment at zero, and then there will be an unabsorbed loss. There will be an unabsorbed loss of 1 lakh rupee, which is going to be shown in the notes to accounts. Which is going to be shown in the notes to accounts in this particular case. So what we'll do, unless and until you earn at least 1 lakh rupee share in the post-acquisition profits of the associate company, you will not be able to show the investment in the books of accounts. So at this stage, you can say the investment appears at zero and the unabsorbed losses is going to be shown in the notes to accounts. So once the associate company starts earning profits, and you are able to get at least 1 lakh share in those particular profits, the investment will not appear in the consolidated financials till that date. This is one. Now let's come to the other case, what we want to discuss. Now, if the associate company is got, the investor company is got, apart from the equity shares, long-term interest, and situation number one, the associate company is a profitable making company. Trust me, there are no challenges in this particular case. There are going to be no challenges in this particular case. So we can directly say in this particular case, there will be no challenges at all. This will be as good as the case number one. So you can say that if the associate company is a profit-making company, it doesn't create any kind of challenges. Now, whether the investor has got just equity shares or whether the investor has got, apart from the equity shares, any long-term interest, it doesn't make a difference. But if the associate company is a loss-making company, then this is the case where we're going to see some challenges. So my area of discussion is the case number 4. So I can say that if you look at the kind of questions which can be created on equity method of accounting, I would say there are 4 kinds of questions. As an investor, you've got only equity shares in the investee company and it's a profitable making company, plain vanilla question. As an investor, you've got equity shares in the investee company, but the associate is a loss-making company. And the problem arises that the share in the losses of the associate company is more than the cost of my investment. My investment in the consolidated financials will be shown at a zero value. And whatever is the losses which could not be adjusted against the cost of the investment, that is going to be shown in the notes to accounts. You'll have to carry forward them as a notes to accounts. Well, we don't have a question on situation number 2, which I can show you. Then I can say, then there are situations when the investor has got some other securities in the investee company, and that would be a situation where there could be 2 situations. The associate is a profitable company. Well, there will be no challenge again. If as an investor, you've got equity and other long-term interest and the associate is a profitable company, it's as good as the situation 1 of case 1. But the challenge comes when you've got other investments and the associate is a loss-making company. I hope, friends, I'm clear with my thought processes so far, right? I hope I'm pretty clear on my 4 permutation combination. I'm now going to discuss the 4th case with you, where as an investor, you've got other long-term interest in the associate company. Then how does the accounting take place for the equity method under indas 28? Great. Now, let me do one thing. Let me come to a very interesting illustration with the help of which I'll be able to elaborate the entire concept to you. Because I'll need to explain this with figures to you so that we are able to understand it better. So I think let's begin the journey. This question is going to take a good time, but I think once you've understood this particular question, trust me, your concept's going to be wow. So let's go to the illustration number 15, where I'm considering 2 factors. This is my case number 2. And situation number 2, where the associate company is a loss-making company, 1, And as an investor, you've got other than equity shares are the long-term interest. Look at the heading of the illustration 15, loss-making associate and long-term interest. Do you think that these are the two conditions which will trigger the case number 2, situation number 2? Yes. So this will trigger the case of appendix of Index 28 when your associate is a loss-making company, 1. As an investor, you've got other long-term interest in the associate 2. Then this will trigger the need of the application of the appendix of Index 28. This is also called in the industry, we call this as impairment. We also call this as, accounting for impairment of the investment in other long-term interests. So this is also called impairment indirectly. It says an entity is following 3 types of interest in an associate. Equity shares, 25%, to which equity method of accounting is applied. Then there are preference shares, the non-cumulative preference shares that forms part of net investment in the associate. What I told you earlier, that this is similar to the concept of net investment in a foreign operation. Remember the concept you might have done in Index 21, where we say that there is a net investment in a foreign operation that's called a NIFO. So here I call it as NIA. That's a net investment in the associate, or I call it as NIJA. There is a net investment in a joint venture. Not NIJA, I would say NIJV, NIJV or NIA, net investment in associate or net investment in the joint venture. So the company has got preference shares, which is a part of the net investment in associate. These preference shares would be such where you can say that they are neither planned to be redeemed, nor there is any intention that it will be redeemed. Therefore, it is long-term. Such preference shares are measured at fair value as per Index 109. Then there is a long-term loan, which has got a 10% interest. The income interest is received at the end of each year. The long-term loan is accounted at amortized cost accounting as per Index 109. And this loan also forms part of the net investment in the associate. So you can very clearly see that the investor has got 2 long-term interests apart from equity shares. He's got preference shares in the associate, which is accounted at fair value. And there is a long-term loan, which is accounted at AC, amortized cost accounting, under Index 109. So these 2 investments are covered under Index 109. Then he says at the start of the year, the carrying values of each of these interest is given. There is equity shares, 10 lakh. There is preference share, 5 lakh. And there is a long-term loan, 3 lakh. So this is the carrying value of these investment in the books of the investor. The following table summarizes the changes in the fair value of preference shares and impairment loss for a long-term loan. Naturally, if these preference shares are taken at a fair value, any increase or decrease in fair value is to be incorporated in the books of accounts as per 109. And the long-term loan is taken at amortized cost accounting, so no fair value changes will be incorporated, but yes, impairment losses will be considered in the books of accounts. So we are given the fair value changes in terms of preference shares and the impairment losses on long-term loans. And we are also given a third column, which gives you the entity share, that is investor share in the profit or loss of the associate company. Throughout year 1 to 5, there has been no objective evidence of impairment in the net investment in the associate. The entity does not have any legal or constructive obligation to share losses beyond the interest in the associate. So the losses will be restricted to the extent of share in the associate company. Based on the above, determine the closing balance of each of the above interest at the end of each year. So we are supposed to make the calculations at the end of first year, second, third, fourth, and the fifth year. I'm going to solve this question by hand so that you're able to get a complete grasp of the concept. So I think let's begin the journey. I hope you are done. Okay, Koshki said we've not done Index 21 yet. Oh, I didn't know that. Anyway, no problems, no problem. Even if you've not done that, that's okay. But just remember that these long-term interest is, you can say, those securities where the investor made an investment in the asset company and the asset company has got no intentions to repay this money. Neither the investor has got any intentions to get the money back, nor the investee company has got any intentions to pay the money back. So it is called as good as equity. You can say this long-term interest is called as good as equity. Now, watch me carefully. Let me start with this illustration and watch me carefully. I'm going to go step by step. So we're looking in terms of the illustration number 15. I am solving the illustration number 15. And in this case, I'm going to go year by year. So I am on year number 1. So let me just note down the data. We are given at the start of the year, the carrying value of the investment is given. So we are given the carrying value of equity shares is 10 lakhs. I am given the carrying value of preference share is 5 lakhs. And I'm also given the carrying value of the long-term loan is 3 lakh. So this is the carrying value of these investments which are given. So these are the 3 securities which the investor has invested. Now, watch it carefully, friends. Go with me step by step. Note it down as well and understand this on a step by step. Now, first of all, what you need to do in terms of the preference shares and the equity, you need to consider the accounting under Index 109. So at the end of the year, for these investments, you first apply the concept of Index 109. Do the calculations which are required as per Index 109. Now, what you need to do as per Index 109? At the end of first year, the preference shares, the fair value decreased by 50,000. So if the fair value of the preference share decreases by 50, can I say the value of this investment at the end of the year is 4.5 lakhs? Fair valuation at the end of the year as per Index 109. Similarly, if you look at the long-term loan at the end of first year, there is an impairment loss of 50,000. So you book that impairment loss, and after the impairment loss, it comes to 2.5 lakhs. So what do you need to do? You need to first of all get the values at the end of the year based on Index 109. I'm talking of only these investments other than equity share. Because remember, this equity share, let me remind you, is not covered under Index 109. It's not covered under Index 109. If you remember, I've given you investment in subsidiary, associate, JV is outside the purview of Index 109, but we apply the concept of Index 27 for separate financials, and being an associate, you're applying equity method under 28, correct? So we have first of all taken the impact of, you can say, Index 109. Now let's get on to the equity method. Now, if you come back at the end of first year, the entity share in the post-acquisition loss is 16 lakhs. So there is a loss of 16 lakhs at the end of the first year. Now the question arises. The equity investment in equity is appearing at only 10 lakh. So you cannot allocate a loss more than 10 lakh rupees to this investment. Because since the carrying value of the investment is 10 lakh, you cannot allocate more than 10 lakh to this investment. Then what happens to that 6 lakh unabsorbed loss? Now think logically. If a company liquidates, what is the order in which the payments are going to be made? If the company liquidates, you will first of all make a payment, you can say, to the long-term loan holder. He gets the first priority in terms of payment on a liquidation. Then after that, the preference shareholder will get a payment. And then after that, the equity shareholders will get a payment. So remember that if liquidation takes place, what is the order in which the money is paid? You're going to pay the loan holders first, then you're going to pay the preference shareholders, and then you're going to pay the equity shareholder. So go with the same order. So who is going to get the money at the end? The equity gets the money at the end. So he gets a loss of 10 lakh to the extent of carrying value. Then who is going to get the money at the end before equity? Who's going to get the money before equity? The preference. So allocate that 4.5 lakh loss to the preference in this case. So you can say the last money goes to equity. He suffers the maximum loss. Then who is the next sufferer after the equity is the preference? So he gets a loss of 4.5. And then I still have, out of that 16 lakh rupees of total loss, we've got another 1.5 lakh. So you can allocate that 1.5 lakhs to the long-term loan. So we know that if a company liquidates, equity will get the money in the end. Preference before that, loan before that. So you should allocate the losses in the same order. First of all, allocate the losses to the equity to the extent of the book value. And then you can allocate the losses to the preference, and then you can allocate the losses to the loan. So you will be able to get a revised carrying amount of these investment. Now, listen to this very carefully. When you booked the impairment losses or the fair value changes, you were applying Index 109. And then after that, you are allocating this unabsorbed losses as per Index 28. Index 28 says, get the carrying values of those long-term investments after Index 109. And then since the asset company is a loss-making company, it doesn't make sense that in a consolidated financials, you will continue to show them at 4.5 lakhs and 2.5 lakhs. If your associate company is a loss-making company, your equity investment has become zero. So the unabsorbed losses should also be allocated to other long-term interest, which is as good as equity, and they should also vanish from the consolidated financials. So now in your consolidated balance sheet at the end of the year, equity investment zero, preference investment zero, and the long-term loan appears at 1 lakh. Am I clear, friends, with the year number one, I guess? Pretty clear, I guess, with year number one, because this is important. As we go further, it'll be slightly more inputs coming in. So basically what I've done, out of 16 lakhs, you can say 10 lakh is allocated to equity. The unallocated amount of 6 lakh is being allocated first to the preference, and the remaining 1.5 lakhs is being allocated to the long-term loan. And now these carrying values are what is going to appear in the consolidated financials at year one end. Okay, wonderful indeed. Okay, now I think let's go to the year number two. Now let's do the calculations based on the year number two now. Similar kind of calculations will be done at the end of each year. So we've got equity, we've got a preference shares, and we've got a long-term loan. And now let's consider the carrying values which you've computed at the end of the first year. So we can say the carrying values now is zero, it is zero, and it is 1 lakh. So this is taken at the end of the first year, the figures which we've computed above. Now, here again, first of all, you need to apply the concept of Index 109 to these investments. You're going to first of all apply the concept of Index 109 to these investments. Now watch me carefully. Let me go back to the second year end. Now, if you look at the preference share at the end of second year, there is a decrease in the fair value to the extent of 50,000. In the second year, there is a decrease to the extent of 50,000. Now you would say, sir, the value of preference share is zero. Now, mind it, friends, the value of, now hear this very carefully, the value of the preference shares in the separate financial statements is not zero. It is zero in the consolidated financials. It is not zero in the separate financials. In the separate financials, it is appearing at 4,50,000. Because it was 5 lakhs at the beginning of the year, and then 50,000 fair value decrease was taken at the end of the year. So you can say the value in the separate financials is 4.5 lakhs. So which means now at the end of second year, there is a further decrease of 50,000. If there is a further decrease to the extent of 50,000 rupees, we can definitely take that hit. So if you can definitely take that hit, which means as per 109, you can definitely take a decrease of 50,000 in this investment. Because in the separate financials, it is appearing at 4.5 lakh. So a further decrease of 50,000 in the separate financial statements can be recorded. And the new value of this investment can appear at 4 lakh. But the problem is in the consolidated financial statements, it is appearing at zero. So what has happened now, this became zero because in the previous year, you allocated a loss of 4.5 lakhs. In the previous year, you allocated a loss to the extent of 4.5 lakhs. So what do you need to do? In this particular case, you should reverse 50,000 rupees. You should reverse 50,000 rupees in this particular case. Since you can say by allocating a loss of 4.5 lakhs, the value in the consolidation has become zero. And if I want to allocate the loss as per 109, then I need to reverse that loss of 50,000 which I took in year one. So what we'll do in the second year, so as to allocate this decrease as per 109, we need to reverse the figure of 50,000 allocated in the previous year. Now let's get to the long-term loan. Now, if you look at the long-term loan, in the second year end, there is no impairment. There is no impairment in this case. Since there is no impairment, nothing is to be allocated in this particular case. Nothing is to be allocated as per 109. So in this particular case now, let us see what is the share in losses. What is the share in losses? Now we're given in the end of second year, the share in losses is to the extent of 2 lakh. So you need to allocate a loss of 2 lakh rupees. How would you allocate the loss of 2 lakh? Equity is already appearing at a zero figure, so nothing can be allocated to the equity. Then the allocation is to be done to the preference, but in this particular case, nothing can be allocated to the preference. Rather, you need to reverse 50,000, which was allocated to preference. Instead of allocating a loss to the preference, you need to basically reverse a loss of 50. So the question arises now, who is going to bear the loss? It is only the long-term loan which can bear a loss, but he cannot bear a loss more than 1 lakh rupees because the carrying value is 1 lakh rupee itself. So you cannot allocate more than 1 lakh rupee. So indirectly, if you see how much have you allocated, you reverse 50,000 for preference, you allocated 1 lakh out here. So the net allocation is done only to the extent of 50,000. Mind the words. Since you reversed 50,000 for preference, you allocated 1 lakh to the loan, you basically allocated a loss of 50,000. So out of that 2 lakh rupees of loss, what is still not allocated but carried forward is 1.5 lakhs in this year. Mind it. Because out of the 2 lakh rupees, the effective allocation done is only 50,000. So 1.5 lakh is the unabsorbed loss, which could not be allocated in the second year. It is going to be written in the notes to accounts. I hope I am pretty clear. Okay, I think Sanipal, so thank you, Kapilesha, sir, for teaching based on mind map. Thank you so much indeed. Okay, I hope everybody is very clear, friends, at this particular case. So what we are looking at is that when you've got losses of 2 lakh, you could not allocate anything to equity. Then in terms of preference, you allocated reversed 50,000 and to the long-term loan, you allocated 1 lakh. So basically the allocation is 50,000 only. So out of 2 lakh loss, 1.5 lakh is still pending. Let me now get the carrying values of these investments at the end of the year for consolidated financials. The equity is zero, the preference is zero, and the loan is also becomes zero. Everything has become zero at the end of the second year, right? I hope pretty clear on the second part, little tricky, but I hope I am pretty clear on this. Okay, Shailendra said if a loss is to the extent of 60,000, then what happens? Well, if the losses in terms of preference, you mean to say that the fair value decrease is 60. If the fair value decrease is 60, then you will have to reverse 60. So whatever is the fair value decrease, you'll have to reverse that 60. And then you can say that to the long-term loan, you will be able to allocate, you can say only 1 lakh. So effectively, only 40,000 would get allocated. And you can say 1.6 lakh will be the unabsorbed losses carried forward to the year number 3 in that case. Okay, so this is the year number 2. Let's get on to the year number 3 now. Let's get on to the year number 3 in this particular case. And I'm again considering equity, I'm considering preference, and I'm considering the long-term loan. So now the value of these investments all throughout is 0. All throughout is 0. So first apply 109. First apply 109. to the preference and the long-term loan, and then we'll consider the allocation of losses under Index 28. Now, if I get back to the third year, now there is increase in the fair value of the preference share. So 1 lakh is the increase in the value of preference share as per 109. So as per Index 109, there is an increase. So now it jumps back to 1 lakh. And in terms of the long-term loan also, in the third year, there is a reversal of impairment loss. A reversal of impairment loss would mean that you're going to increase it by 50 because you're reversing the loss. So now we can say after 109, the values are standing positive. 1 lakh positive for the preference and 50,000 positive for the preference. Now let's have a look at what is the losses as per the equity method. Now, third year, there is no loss in the current year, but when you consider this case, now watch me carefully. When you go to the third year, you need to consider that there is no loss in this year, but there was a carry forward loss of 1.5 lakh related to the previous year. So you need to be careful that now the allocation is equal to the current year share in loss and the carry forward loss both. So you need to consider the current year losses and you need to consider the carry forward losses both into account. So you need to consider what is the carry forward portion and the current year combined, which is 1.5. Nothing can be allocated to the equity because it is appearing at 0. But now you can allocate 1 lakh to the preference and you can allocate this 50,000 to the long-term loan. So which means entire carried forward loss got allocated towards preference and long-term loan and it becomes 0. So it has got perfectly matched at this particular case because the amount allocated to preference and the long-term loan is exactly 1.5 lakhs. But it could have been a situation where there's still an uncarried forward losses. Like year number 2, we could not allocate everything. Then year number 3 also, it could have been possible that it's not carried forward. Then you would have taken the remaining in the 4th year. So now we consider what is the carrying value of these investments at the end of the 3rd year. It is all supposed to be 0. So the important thing is that you need to first of all do the allocation as per 109. And then you need to do the allocations as per Index 28. And then get the amount of carrying amounts and just keep a track of what is, carried forward to the next year as well. Okay, now with this particular inputs, let's go to the next year with you, and that is the year number 4. So now there is no carry forward losses. We are going to the year number 4 in this particular case. And when we're going to the year number 4 in this particular case, again, we consider the value of equity, we consider the value of preference and the long-term loan, and the carrying value of these investments is now all 0. Based on the position at the end of 3rd year, we've got all the values is appearing at 0. Again, we need to apply Index 109 to these investments. So let's go back to the 4th year. In the 4th year, there is a fair value increase of 50,000 on the preference and no impairment or reversal on the long-term loan. So 50,000 is the increase in the fair value of this investment as per Index 109. And in terms of long-term loan, there is no impact at all. Now it's time that we allocate the losses. Again, keep a track that current year losses and carry forward. There is no carry forward losses in this case. And in the current year, if you go, finally, we are getting a share in profits. Now comes the twist. Now we are getting a share in the profits to the extent of 10 lakh. Now we don't need to allocate the losses, but we need to allocate the profits. Now watch me carefully, friends, at this stage. Now we need to consider the allocation of the profits at this particular stage. Now, when the losses were distributed to the equity first, then to the preference, and then to the loan. So when you go to allocate the profits, since the long-term loan has borne a loss, you need to make good the loss. Since the preference shares has borne the loss, you need to make good the loss. Now the profits will be allocated in the same order as you've given the losses. You will give the long-term loans the profit first. To the extent they've borne a loss, you're going to give the preference shares a profit to the extent they've borne the loss. And then finally, whatever is left over will go to the equity. So remember, when you were allocating the losses, it was equity preference loan. When you go to allocate the profits, it's loan preference equity in the reverse order. And you need to see that whatever losses have been allocated till date, you'll reverse that. Now let's go back to the long-term loan from year number 1 onwards and see whatever is the total losses allocated to them so far. Now, in this particular case, you can say in year number 1, you allocated a loss of 1.5 lakhs. In year number 2, you allocated a loss of 1 lakh rupee. You allocated a loss to the extent of 1 lakh rupee. So we can say it became a total of 1.5 plus 1, 2.5. Then in third year, you allocated another loss of 50,000. So that makes it what? So that makes it, I think, a total of 3 lakhs. So it was 1.5 plus 1, 2.5 plus 50, 3 lakhs was allocated so far. Since you've allocated a total loss of 3 lakhs till date, you're going to first of all make good the loss and give 3 lakh share in profits to the long-term loan. So you need to go back from year 1 to year 3, calculate the accumulated losses which you've allocated to the long-term loan so far, and then you need to first give the share in profits. Now let's go to the preference and see what is the losses allocated to them in all these 4 years. To the preference, you allocated 4.5 lakhs year 1. And then you reversed 50,000 in year 2. So 4.5 lakhs allocated, then 50,000 reversed in year number 2. So net is 4 lakhs. And then in third year, you allocated another 1 lakh. So you've allocated a total loss of 5 lakhs to the preference in this case. So losses of 5 lakhs have been allocated so far. And now out of the 10 lakh rupees, whatever is the balancing figure, which is 2 lakh rupees, is going to be allocated to the equity. So you make good the losses of the loan first, then you make good the losses of the preference, and then whatever is the balance goes to the equity. And we are now in a comfortable position to get the carrying values at the end of each year. So equity is now appearing at 2 lakh because from 0, you've added another 2. Preference in this case is an increase of 50 plus 5. It makes it 5.5. And in terms of the long-term loan, it is 0 plus 3. It makes it 3 lakh. So this is the value of investments at the end of the 4th year. And similar calculations are now going to be done at the end of 5th year. Okay, Kaushik, you said in year 3, do we need to reverse anything? In year 3, no, there is no reversal, because in year number 3, if you notice, I had a gain of 1 lakh rupees, so I could allocate a loss. I had a gain of 50 due to reversal, so I had to allocate a loss. So in a situation where you see that the carrying value becomes nil and you need to allocate something as per 109, only then a reversal would take place. Now let's go to the year number 5. So with this 4th year now, we can go to the year number 5, a very interesting illustration indeed. And let's consider now the values of these investments computed at the end of 4th year, equity preference as well as the long-term loan. So if you look at the values of these investment, it is appearing at 2 lakhs, it is appearing at 5.5 lakhs, and it is appearing at 3 lakh rupees. So this is the value at the beginning of the 5th year. Now let's, I think, go back to the Indas 109 application. We can see in 5th year, there is an increase in the fair value of preference again by 30,000. So we need to apply Indas 109 to the extent of 30,000 increase. And there is nothing in terms of the long-term loan, so that is appearing at 0. So in this particular case, now there is increase in the fair value. Let's see what is to be allocated. Now, we need to be careful every stage. Is there any carry forward losses or not? There are no carry forward losses as compared to the previous year. So in the 5th year now, again, there is a share in profits appearing to the extent of 10 lakh. So we've again got a 10 lakh rupees profits. Now, what we need to be careful on? We need to see that, is there any amount of losses which needs to be reversed for the loan? We have reversed the entire losses allocated to the loan. We have reversed the entire losses allocated to the preference shares. In the year 4 itself, we could manage to reverse the entire losses which were allocated to the preference and the loan. So which means now there is nothing which is left over to be allocated to the preference and the loan. Had there been something which is left over compared to the year number 4, we would have done this at this stage. So in this particular case, the entire 10 lakhs is going to be allocated to the equity itself. So we can now calculate the carrying values of these investments for the consolidated financial. So this will be 2 plus 10, it appears at 12 lakh. This will be 5.5 plus 30, it appears at 5.8 lakhs. And this is going to be 3 lakh plus 0, it continues to appear at 3 lakh. So these are the carrying value of these investments at the end of the 5th year for consolidated financial statements. Trust me, you need to solve this question with your hand once. I'm not saying that you would have got 100% confidence in terms of this particular question, but I think if you are able to, do it once with your hands, trust me, you're going to get a very good comfort zone. It's a little tricky question, but there are certain parameters you need to be careful on. So when you're allocating the losses, you need to be careful that you need to first apply 109, followed by index 28. And then you need to be also careful that when you're considering the application in terms of allocating losses, keep a track of unallocated losses, which is going to be carried forward in the next year. Because every time you're going to allocate the loss, you're going to consider the current year loss and the amount of carry forward losses as well. The order in which allocation of losses is to be done, the order in which the reversal of losses needs to be done. So these are the small little issues which you need to keep in mind. Okay. So wonderful indeed. I hope everybody is pretty clear so far what we've done. Okay, Kaushik said, is there any alternate method in year 4? Can we simplify to calculate the figures as per the separate financials? Well, in year number 4, if you notice, the thing is that all these calculations are being done from the point of view of index 28. And when you're doing the calculations from the point of view of index 28, you don't see that there is any other alternative calculations you can do, because allocating the profits would mean you have to go back to the 4 years and see whatever is the accumulated losses allocated till date. Even in terms of long-term loan, you have to go back and do it. I don't see that there would be a shortcut to do that. So I think you'll have to go back and see the accumulated losses booked till date for all the cumulative years 1 to 3. Right? Okay, so far so good. So I think this takes care of this particular aspect. I think now it's time to give you a break as well. So I think we're done with the 4th agenda as well. And I'm left with the 5th agenda, which is where we are going to discuss with you the aspect of changes in the ownership part with you. And I need to do a little discussion with you on index 27 as well, but that would be just a very few minutes with you, because index 27 is pretty simple from the examination point of view. So I think let's first give you a break of around 10-12 minutes to you, friends, and then I think we commence back with you. So enjoy your break. I'm going to see you after the break in another 10 to 12 minutes time. Welcome back, friends. So I hope you had a little adequate rest in the break as well. It's important to give a little rest to the mind as well. So I think let's take the journey forward in terms of the standard. I think in the meantime, there is some question which is there as well. And I think, Shubham, you said the carrying amount at the beginning of year one, net of impairment loss or gain of 5 years, is equal to the carrying amount at the end of the fifth year. Well, I think that's only for the reason that the entire impairment loss which we had recorded is got reversed as well. So I think that's the reason that, why the carrying value is equal. Because if you notice in the particular question, we are given the status as far as the long-term loan is concerned. At the end of first year, there was an impairment loss, and then the equal amount of losses got reversed at the end of third year. So naturally, the carrying value of the investments is appearing at the same figure. And you would watch another very interesting inputs in this particular case. If you consider the total losses is being 18 lakhs and the total profits in terms of the equity is 20 lakh. So you can see that there is, a net increase of 2 lakhs over a period of 5 years. I mean, just making a little analysis and considering that, the net amount of increase in the equity is 2 lakh, naturally, whatever might be a decrease in the value of preference and long-term loan over a period of 5 years, but they will, come back to the same figure. Because at the end of it, if you look at all the 5 years put together, the net result is that there are no losses, which effectively needs to be allocated to the preference and long-term loan. Right. I think I would have made sense on what I said. Okay, now moving forward with you on the next agenda. If you remember, I had taken a list of 5 issues with you in terms of this particular index. So I've covered almost like 4 issues with you, because if you remember, I started my journey on the number 1 aspect, where I taught you how the significant influence is assessed. We looked into the cases of assessment of a significant influence. And then I went to the second area and we saw the cases of exemptions, the areas where you get a choice of not applying an equity method, and also a case of exception, which I gave you. Then the third area of discussion is the equity method of accounting, how the equity method of accounting is done. And I've done the fourth area with you, wherein I've seen that if you've got, let's say, other long-term interest in the associate company, how does the accounting take place? Now, there is another fifth area which I need to discuss with you. Well, there are not too many, permutation combinations of questions given in the study material in this area. But if you look at the education material, there has been a discussion on those area. So I think I'm planning to, quickly give you some inputs on that area. And that is what we call the change in ownership percentage. There is a change in terms of percentage of stake which the investor has got in an associate. And I think the most troublesome area is, when people tend to get confused in terms of what do we do with that other comprehensive income which has been accumulated over a period of time. So I think let me just take another almost like half an hour or so. And I promise you that in the next half an hour, you're going to get a very good clarity in terms of various permutation combinations. I always keep telling people also that if you want to be very clear in terms of the accounting for a change in ownership percentage, you should technically deal it like a separate section of understanding. Because you would remember that you've done certain cases in Index 110, where you saw the cases when there is no loss of control, or you saw the cases when there has been a loss of control. And then some cases you also remember might be doing in Index 103, where you saw the cases of typically step acquisitions, and a few cases we're going to cover out here. So a few cases gets covered in 103, a few cases gets covered in 110, and a few cases we're going to cover in Index 28. But if you want to get a very good understanding, I would say, bring all those cases in one particular place and see in which permutation combinations, what kind of accounting is done. Now, before we start, I think this area of changes in the ownership, let me, I think, first give you a chain of thought that how do you need to think on this particular area? Now, I would say when I'm looking at my section number 5, that is the change in percentage, my mind starts working in this direction, that there can be 2 possible permutation combinations to begin with. The first permutation combination is that there has been a further acquisition. It's not a case of disposal, but it is a case of a further acquisition. And the second is that there could be a case of a disposal. So either it is a case of further acquisition or it is a case of disposal. And if I look into the kind of cases I'm looking into each category, I would say in terms of further acquisition, there are two main cases coming to my mind. One is that where you say that a significant influence, let's say, continues. You already had a significant influence over the investee company, and even after acquiring a certain stake, the significant influence continues in this particular case. The next area is when you say that you were a passive investor earlier, and when you were a passive investor, it gets converted into a significant influence. So typically in this case, you can say that you were covered under Index 109 earlier, and with a significant influence now, you are moving to Index 28 now. So I think let me just concentrate on the further acquisition to begin with. So we can say that when a company as an investor acquires more stake in a company, so there can be two possible permutation combinations from this standard perspective. Either a significant influence continues, you already had a significant influence and it continues, or it is a conversion of a passive investor to Index 28. Now, to my mind, in order to get a clarity of thought, it is important that in both these cases, there are, I would say, three agendas which needs to be very clear. So I would say there are a total of three issues where you need to be very clear. If you're clear on these three issues, I think nothing will stop you in terms of doing the correct accounting in these permutation combination. Now, number one. The first issue is what I call a PHI. Now, when I say PHI, the concept of PHI means a previously held interest. So you've got a previously held interest. Like, for example, you had a 30% stake in a company. You acquired another 10% stake in the company. So I'm looking at the 30% stake, which you already had, is called a PHI. The question arises that if it is a significant influence, is there a need to go in for, a remeasurement of a PHI or not? So let me tell you that in the first case, if you're looking at the first case where the significant influence continues, there is no need to remeasure the PHI. The book value of the previously held interest is not required to be remeasured in this case. But if you're looking at a conversion of a passive investment to a significant influence, then there is a need to remeasure this PHI as well. Now, the question rises that once you're going to remeasure the previously held investment, where are you going to take the profit or loss on the remeasurement of the previously held interest? Now, let's, I think, discuss that. Now, you would recall that when you are a passive investment, when you've got a passive investment in equity shares, then Index 109 allows you that if this investment is not held for trading, if this investment is held for trading, then it is taken as FVTPL. And if this investment is not held for trading, then this investment is either taken at FVTPL or FVTOCI NR, because equity investments are always with a no recycling. So considering that the investor definitely, wanted to get a significant influence over the company, I would presume that the company, the investor always acquired this investment and it was never a case of held for trading. So considering that it was not a case of held for trading, the investor would have got a choice in terms of accounting either under FVTPL or under FVTOCI. So I would say that generally, if you make investments where the held for trading objective is not there, the company, let's say, would have taken an FVTOCI. That's a presumption that the company might have taken an FVTOCI. So if they would have taken a FVTOCI concept, we can say the moment the investment is revalued, then any kind of gain or loss arising on the remeasurement is going to be parked in the other comprehensive income. So I think I made myself very clear that if a company acquires a further stake in the company and you say that the significant influence was already there and you acquired a further stake in the company, there is no need to remeasure the previously held interest. But if it is a case of a movement, because in this case, you were already under Index 28 and you still continue under the same standard. Now, since you're going to continue in the same standard, there is no need to remeasure the PHI. But in the second case, when you're converting from a passive investor to a significant influence, you're moving from one standard to another standard. And therefore, in this particular case, a remeasurement needs to be done. And whatever gain or loss will come, considering that you would have taken a FPT OCI approach of measurement, you need to basically recognize a gain or loss in the OCI. That's issue number one. Second. The second is the treatment as far as goodwill is concerned. Now, let's watch this carefully. When you already had a significant influence in the company, you would have already computed a goodwill for the initial stake acquired. So now the question rises that do we need to calculate a goodwill for the additional stake as well? So like, for example, you had a 30% stake in the company and you acquired another 10% stake in the company. Do we need to calculate the goodwill for that additional stake acquired? The answer is yes. So in this particular case, we can say there will be a need to calculate a goodwill for the additional stake only. We need to calculate the goodwill for the additional stake only, not for the entire one, because you've already computed a goodwill for the initial percentage. So you need to calculate a goodwill only for the additional stake in this particular case. The next is that once you say that it was a case of passive investment, well, we never made any calculations of goodwill. Because when you were covered under Index 109, you never made any calculations of identifying goodwill at that stage. So in this particular case, you'll have to calculate the entire goodwill. You need to calculate the goodwill which is on the entire stake itself. I think it makes a logical sense as well. So now you would have realized that the key issue number one is that do we need to remeasure the PHI or not? And the issue number two is that do we need to calculate the incremental goodwill for the incremental stake, or do we need to calculate a goodwill for the entire stake? Then I would say finally, the third thing is that you need to have a little clarity in terms of the journal entry which you will pass. That when you acquire additional stake in the company, what kind of journal entry are you going to pass in this particular case? Now, I think if I again go to the first case, which is a situation of a significant influence continues, you can simply put the entry investment account will be given a debit and the bank account will be given a credit. Simple and straight. Because in this particular case, you're only, and this is the entry for the additional stake. The company has acquired an additional stake. So this entry is going to be passed with the additional stake itself. Whatever consideration is paid for acquiring the investment, you can do the entry in this case. This is the entry which I'm giving you for the consolidated financials, not for the separate, because accounting in a separate financials is going to be absolutely simple and straight. So in this particular case, the entry is going to be investment to bank. Now coming to the case where it is a conversion of a passive investment to a significant influence. Now, I would say in this particular case, what you need to do in this particular case is you should put the entry investment account debit. This is like the new investment which you are calculating based on equity method. And I would say that it's time to de-recognize the old investment. So this is the recognition of the new investment based on Index 28 principles. And this is a de-recognition of the old investment based on the Index 109. And whatever is the difference which will appear in this particular entry, as we've already said, that this is the revalued figure. So if you're going to get any difference in this particular entry, you're going to put it in the OCI or the profit and loss as the case might be. Now, one very important inputs which I'd like to give you at this particular stage. Can I say the next question which arises is that since you would have accounted for this investment based on FPD OCI, mind it carefully. Since you would have accounted for this investment based on FPD OCI, can I say there must have been an accumulated amount which must have got accumulated in equity statement? Because year by year, the fair value changes would have been taken to the OCI, and from there, it must have been taken in SOKI directly. So there will be an accumulated amount which is lying in the SOKI. And I think needless to remind you, that in case of equity investment, this OCI comes with a no recycling. So whatever is the accumulated amount in that equity statement is going to be transferred to the retained earning. So this amount is going to be transferred fully to retained earnings. 100% of this amount in the equity is going to be transferred to the retained earning. I think let me just quickly give you a grip once again on this area. I know it's slightly tricky, but I think let me just give you once again the input. Okay, I think Koshki, you said, why won't we talk about control, sub-acquisition or disposal? Well, I think those kind of cases you've already covered in Indes 110 actually. So I'm not, looking at further acquisition where a significant influence gets converted to a control. Now that you've already covered in Indes 103. So I'm just taking a few cases, which are given in the study material with reference to Indes 28. The other combinations, some of them are in 103, some of them are given in 110, but I think you can gather them up all at one place and see, what happens in different permutation combination. Okay, so let me just give you a brief once again and get the clarity of thoughts. So I would advise that when you're looking at a case of a further acquisition, in terms of Indes 28, I'm just looking at two combinations. I'm just looking at two combinations that either you already have a significant influence and you acquire a further stake and the significant influence continues. You are already under Indes 28 accounting and you're still under Indes 28 accounting. The second case is that you were covered under Indes 109 because it was a passive investment and you acquired a further stake and it converts to significant influence. So only two cases we're doing in further acquisition. Now, remember that in order to keep a track, there are three important issues which you need to keep in mind. So you need to keep in mind, number one, that you need to be clear on the PHI. What is the status of the previously held interest? Is it to be remeasured or not? The second is we need to be clear on the aspect of goodwill, that is there a need to calculate a full goodwill or is there a need to calculate an incremental goodwill? So PHI is one thing you need to focus on. Goodwill is another thing you need to focus on. And you need to be clear on the entries which you will pass in consolidated financials. So considering the two cases, to give you a quick brief once again. If you say that a significant influence continues, there is no need to remeasure the PHI. But if you say that it is a conversion from 109, a passive investment to significant influence, you need to go for a remeasurements in this case. And I would say, considering that your previously held investment was accounted under FPTPL or FPTOCI, as the case might be, you're going to accordingly take the gain or loss on remeasurement to the OCI or PNL. Generally, they might have measured it on OCI, but depending upon the measurement, you will remeasure. So if SI continues, there is no remeasurement. And if there is a conversion from passive to significant influence, remeasurement takes place. Number two, if you look at the case of goodwill, since you already had a significant influence, there is a need to calculate only incremental goodwill. You're going to calculate a goodwill only to the extent of that additional percentage stake acquired. But if there's a conversion from 109 to 28, then naturally we never computed any goodwill. So there is a need to calculate a full goodwill. So how would you calculate a full goodwill? You will take the money paid for the additional stake. You will consider the revalued figure for the PHI and compare it with the net assets on the date of acquisition, because the date of acquisition is the second date. And you will compare the total cost of new acquisition and the old acquisition at fair value, and you get a full goodwill in this case. Entries are fairly simple, that if it is SI continues, investment to bank. But if it is a case of conversion from one standard to another, you need to de-recognize the old investment, recognize the new investment based on equity method, get the profit loss taken in OCI or PNL, and most importantly, that if there is any accumulated balances in the other comprehensive income, since it is a no recycling, you need to simply put the entire money to retained earnings account. Right? I guess so far so good. The further acquisition combinations are pretty clear, I guess. Everybody's, I think, pretty clear in this particular case, I believe. Okay, now I am going to come to the next agenda. That is a case of disposal, and 2-3 cases are coming to my mind in terms of disposal as well. So when I'm looking in terms of disposal, My mind is working on basically three cases with you. The case number one is that you can say a disposal resulted in a significant influence continues. The first is that the significant influence continues. And the second case is that it is a conversion from a control to a significant influence. I think this is something which you've done in terms of, I guess, Ind AS 103 or maybe Ind AS 110, I guess. Because there is one particular illustration which is given on Ind AS 110, where there is a conversion from a control to a significant influence, which is a beautiful illustration, a very comprehensive illustration in the study mat, which is also there in the education material as well. And the third case is that it is a case where you convert from a significant influence to a passive investment. So I would say these are the three permutation combinations which would come in. That when there is a disposal, either you can say that you already had a significant influence, even after disposal, it continues. Or it is a case of a control getting converted to significant influence, or it is a case of a significant influence converted into a passive investment. Now, watch me carefully. I think in this case, the question of PHI doesn't arise. I think in this particular case, again, the question of goodwill being calculated does not arise, because this is not a case of acquisition, but a case of disposal. So I think out of the three issues, I'm not worried on PHI. There is nothing like PHI. I'm not worried in terms of goodwill. My only focus in this case is the journal entry. The journal entry is the only focus. And I think, let me now give you some inputs at this particular stage. Now, if you look at the study material, there are a few questions which are given here and there on these area, but you will not find all the 5 cases which I'm discussing with you, because 2 cases are on the further acquisition and 3 out here. But you can see, if you want to practice a bit more, you can see a few of these cases are given in the education material. Rather, I would say all the 5 cases are there in the education material. But in some of the areas, it's a little gray area as well. The standard is not very clear in terms of what accounting would apply. So I think maybe you can concentrate on the study mat, but I think for those who are a little more inquisitive and they want to get a little more extra edge of knowledge as well, then I think you can refer, maybe if you want on your own, refer the education material for these combinations. So conceptually, I would have given you the inputs. Then based on that, you can start working and do a little more detailed study. Okay, now watch me carefully. If you say that a significant influence continues, then in that particular case, what you need to do, you need to put the entry bank account debit. And this is to the extent of the sale proceeds, and you will have to give a credit to the investment on a pro rata basis. On a pro rata basis, because you're selling a certain stake. Let's say, for example, you had a 40% stake and you've sold a 10% stake. So from a 40%, you came to a 30% stake. So basically you've sold, you can say 10%, or you can say 25% of the existing portion. Mind the words carefully. You're selling 10% in totality, or you can say you're selling 25% of the existing investment. So what you can do, in this case, you can take 25% of the value of the investment in the books of accounts. The bank will be given a debit to the extent of the sale proceeds. The investments will be given a credit, which is to the extent of pro rata value of the investments. And any balancing figure in this entry is going to be considered as a profit or loss, which is going to be taken to the P&L. Now, friends, something very interesting to watch out. Now, hear this very carefully. When you applied an equity method, in this particular case, can I say by applying an equity method in this particular case, you would have accumulated a credit in the OCI as well. Remember, the equity method of application means investment to P&L or investment to OCI. So the question rises that during the course of application of the equity method, you would have actually accumulated an amount in the other comprehensive income. If you would have accumulated a percentage in the OCI, can I say that must have been based on a 40% figure, right? And now your stake is left over to the extent of 30%. So does it make sense that 10% of the disposal, that proportionate amount from the OCI needs to be transferred to the retained earnings or to the profit and loss account, as the case might be? I hope I'm making sense. So you would have accumulated an amount in the OCI, whether it is a recycling or no recycling, because when you apply the equity method, you would have done the entry investment to OCI, and the amount in the OCI could have been a case of OCI recycling, or it could be a case of OCI no recycling. So the amount which is there in the recycled part is to be transferred to the profit and loss, and the portion which is there in the no recycling part is going to be taken to retain earnings. I hope, friends, I'm making sense, because this needs your input on what you've learned in Indes 103 as well. Are you clear in terms of what I'm saying right now? That in this particular case, when you're looking in terms of the OCI balances accumulated due to the equity method application earlier, you've got a 40% stake which has got accumulated. Now, since you're left with a 10% stake, you need to push out an amount from the OCI, and you need to push that amount either to the retained earnings or to the profit and loss account, as the case may be. As the case may be. Because you need to see that whatever is the portion which is relating to no recycling will go to the retained earnings, and whatever portion is related to recycling is to be taken to the profit and loss account. And this will all be done on the basis of pro rata figure. We'll take a proportionate figures to the extent of disposal and push it to the RE and push it to the profit and loss account, right? Okay, that's, I think, wonderful indeed. Now let's go to the next one. I think the conversion of control to a significant influence, I think you've already covered in Indes 110, I guess. Have you seen that comprehensive illustration in the study mat where there is a disposal and a control is getting converted into a significant influence? Do you remember that particular case where a certain amount is being pushed from the OCI? There were, 2-3 amounts in the other comprehensive income. Remember doing that particular illustration? Yes. Okay. So that's wonderful indeed. Okay, you said a yes, right? You've done that illustration, but let me just quickly remind you the facts in this case. When you say that it is a situation of a control to a significant influence, what I do in this particular case is, for convenience, I basically do an entry which is a reverse of Indes 103. I do an entry which is a reverse of the acquisition accounting. Because since you had a control, you would have consolidated the subsidiary. And now, since you've got a loss of control, it's a case of derecognition. So what do you do in this particular case? You record bank is given a debit to the extent of sale proceeds, and investment which is retained is given a debit at a fair value, because whatever investment stands retained, that is going to be recorded at a fair value. And the NCI will also get a derecognition from the books of accounts. The net assets will also get a derecognition in the books of accounts, and the goodwill will also get a derecognition at this stage. So basically, it is nothing but a reversal entry of Indes 103, where the company would record the sale proceeds and debit the bank, recognize the investment to the extent of the retained portion at a fair value, derecognize the NCI, derecognize the goodwill and the net assets. And any balancing figure in this entry is taken to the profit and loss account, representing the gain or loss on disposal. And then again, apart from this, here again, when you do the consolidation, you again follow the same concept. The consolidation would mean that you would have aggregated the items of incomes and expenses line by line in the consolidated P&L. So can I say, even due to the application of Indes 110, you would have accumulated an amount in the OCI, or you would have accumulated an amount in the profit and loss account, right? So the question arises, is a similar treatment going to apply what you did in this case as well? Yes. A similar treatment would apply in this case as well. You need to calculate the proportionate amount, and you're going to push it from the OCI to the retained earnings and the P&L. So the same thing will apply in this case as well. You will have to see what is the amount accumulated in OCI. To the extent it relates to, you can say, the amount which is no recycling is going to be taken in the retained earnings. To the extent it relates to the recycling figure, you're going to push it to the P&L account. And all this is again going to be done on a pro rata basis again. So you can say the only thing which you need to be careful is how much amount out of the other comprehensive income accumulated due to the equity method application or accumulated due to the consolidation of 110 application is there in the books of accounts. So a proportionate amount out of that OCI to the extent of the disposed portion needs to be pushed to the retained earnings and need to be pushed to the profit and loss account, depending its recycling or recycling. You need to carefully go through the process, and you need to carefully have a look at, scrutinize the figures which align in the OCI and see, is it a case of recycling or no recycling, and accordingly push it to the retained earnings and to the profit and loss account. Finally comes the third case, when it is a case of a passive investment. Now, when it is a case of a passive investment, then in this particular case, what do we need to do? Since now the signal influence is gone, what do you need to do in this particular case? You need to recognize the investment. This is the fair value of the investment which you've retained as a passive investor. You need to go in for a derecognition of the previous investment. And of course, bank will be given a debit as well. So you will give a debit to the bank to the extent of sale proceeds, then recognize the investment based on the passive investor, de-recognize the old investment, and any balancing figure would be a gain or loss, which you would put it in the profit and loss account as well. Now the question arises. Here again, you've got a balance in the OCI. Now this time, let me ask you, are you going to push the entire amount? Are you going to push the entire amount from the OCI or a proportionate amount from the OCI to the retained earnings? You can think logically. Now, in this particular case, we can definitely say one thing, that in this particular case, it's a movement where you're moving out of the index 28 and you're moving to index 109. And it's a complete change in terms of relationship. So what do you do in this particular case? Are you going to push out the full amount in the OCI? Yes, that's rightly said. So in this particular case, you will remove the full amount from the OCI. And again, depending whether it is recycling or no recycling, you'll put the retained earnings, the no recycling portion, and the P&L to the portion which is recycled. Wow, slightly complicated, but I thought I'll just give you a quick review on that. So let me just make a consolidation of the inputs I've given you. Based on this, there is one or two simple questions which are there in the study material as well, but I've given you a larger picture in terms of things. So I think let's make a quick summary view, which will give you a very bird's eye view of what needs to be done. So that we are very clear on the agenda. So I'm just going to make a quick chart. You can take the chart down as well, and maybe in between you can answer the questions as well. Now my mind is working on all the 5 permutation combinations, and I am thinking of making a comprehensive chart with you so that we get a clear-cut understanding of the various issues which we will confront in this case. So I can say one is a case of a further acquisition. That's a larger case. And within the concept of a further acquisition, we've got 2 sub-cases. One is where the significant influence continues. The other is that you've got a significant influence and, a passive investment, and you convert into a significant influence. Then there is a case of a disposal. And in case of a disposal, we've got 3 cases out here. One is in a case where the significant influence continues. And one is a case where you've got a control and it gets converted to a significant influence. And one is a case where you've got a significant influence and it gets converted to a passive investment. Now, as I said, the clarity of thought is required on certain agendas. So I think if I make a combinations of the issues which I need to keep in mind, we can say number 1. We can say number 1 is with regard to PHI, number 2 with regard to the goodwill, and number 3 with regard to, I would not say the entry, but let's consider the impact of the amount which is accumulated in OCI. So I think these are the three agendas, most importantly, which I need to keep in mind. So if I think I am able to fill up this particular chart, then I think I am done with my concepts. Okay. The first thing is that if it is a case of disposal, then the concept of PHI is not applicable. Because in this case, the concept of remeasurement of the PHI does not arise. The calculation in terms of the goodwill, in this particular case, there is no additional goodwill to be taken, but yes, a derecognition would take place that can be seen in the entries. Okay, so these are the issues which will impact a further acquisition. If you are saying that there is a significant influence and it continues, then there is no remeasurement required. But if you say that you're moving from a passive investor to a significant influence, remeasurements of the PHI is certainly required. So you need to be very clear that the remeasurements of the previously held interest will be done when it is moving from one standard to another standard in a further acquisition, where you were under 109 and you move to indas 28. Okay, next. In terms of goodwill, if the significant influence continues, you need to calculate a goodwill, but you need to calculate only the goodwill for the additional stake, not for the entire stake. You already have a goodwill for the initial stake. You just need to take care of the goodwill for the additional stake in this case. But if it is a movement from a passive investment, you need to calculate the entire goodwill itself. You will consider the cost for the additional acquisition and the fair value of the PHI. You're going to consider the sum total of the fair value of the PHI and the cost for the additional investment, compare it with the net assets at a fair value, and get a full goodwill. Okay, now coming to the concept of further acquisition. If a significant influence continues, do you need to touch the amount in the accumulated OCI? No. You don't need to touch the amount in the other comprehensive income. It continues. But if it is a case of passive investment, then as per 109, you would get an accumulated amount in OCI. So is the entire amount going to be transferred to the retained earnings? Yes. So what you need to keep in this case is you need to transfer 100% of the amount and 100% will go to RE, nothing to the P&L. Because in this particular case, it is a case of no recycling. So you will transfer 100% of the amount, one, and you will transfer 100% to the RE. Nothing is going to be taken to the profit and loss because it is a case of NR, no recycling. Now let's go to the case of disposal. If a significant influence in this particular case continues, then you need to remove an amount from the OCI. And this time, is it going to be 100%? No. This is going to be, you can say, pro rata. Instead of 100% in this particular case, a pro rata amount will be transferred and it will be transferred to the retained earnings or to the profit and loss as the case may be. Unlike the previous one where it was being pushed to the retained earnings, this is going to be taken to the retained earnings of the P&L. So if it is no recycling, RE. So you'll have to scrutinize what relates to the no recycling portion and what relates to the recycling portion. Then in the next case, when a case of control to a significant influence comes, again, you need to transfer the entire amount in the OCI. Sorry, you need to transfer an amount from the OCI and the status is the same. The status is the same. A proportionate amount will be transferred and that will be taken to the RE or the P&L as the case may be. Scrutiny of the OCI needs to be done. And in the third case, when you say that now you become a passive investor, you need to transfer the amount and this time 100% will be transferred. 100% will be transferred. And in this particular case, again, you'll have to see retained earnings or profit and loss as the case may be. Same case, scrutiny, and then you decide RE or the P&L. I think that gives you a bird's eye view. You can maybe start researching on these things and do some questions based on this. You'll find questions in the education material on all the permutation combinations. I am not taking you to the education material to do questions, but I think I've given you the larger picture. Okay, I hope so. I am pretty clear on this agenda so far. Okay, wonderful indeed. I think there's a question. Shobham, getting it clear? Wonderful. Kaushiki, in case of further acquisition, OCI treatment is not clear. In case of further acquisition, okay. Well, in case of a further acquisition, remember that it is only a case of a passive investment to signal influence. Now, let me just make a walkthrough with you in this case. Imagine when you were covered as a passive investor, you would have applied Index 109. Can I say in terms of Index 109, you can either choose an FPTPL or FPT-OCI. If you choose FPT-OCI, it is no recycling only. It is no recycling only. So which means one thing is pretty clear, that you cannot push any amount to the profit and loss account. The amount to be transferred is going to be in the retained earnings itself. Now, I'll give you a little logic also of why we are pushing 100% or why we're pushing a pro rata figure. Now, watch this carefully. Let me give you a very basic understanding. When you're looking at investment accounting, it could be a case of control, or it could be a case of a signal influence. Let's not talk of joint control, or it could be a case of passive investment. Now, you need to understand one thing carefully. When you account for a control, you use a full consolidation. So when you use a full consolidation, investment takes a credit in the P&L also. Investment takes a credit in OCI also, because line to line addition. So as an investor, you would take a share in the profits in the P&L, the share in the OCI in the OCI. So line by line, everything will get added. Even if it is a signal influence, during the course of equity method, you again take a credit to the P&L and the OCI as well. The passive investment is the only case where you do not take any credits to the P&L or the OCI due to the change in the movement of equity of the investee. Mind you, if it is a case of control, you are accounting for the change in equity. I'm saying when you've got a control, you are accounting for the change in equity. When there is a signal influence, you are accounting for the change in equity. Though the technique is different, but the concept is same. In case of a control situation, though there is a full consolidation, you are accounting for the post-acquisition movements. In a signal influence also, you're accounting for, you can say, the post-acquisition movements. But Index 109 is the only standard where the post-acquisition movements are not being captured. So you can notice one thing, that when you move from a control to SI or SI to a control, in this particular case, you will notice that we are moving only a proportionate amount of money from the OCI. But if you're moving from a signal influence to a passive or a passive to signal influence, you're moving 100%. Because in that case, you were not earlier accounting for the equity change, or you started accounting for the equity change. So now you would see that when you're moving from a particular standard where equity accounting is not being accounted for, you are pushing 100% of this money, because you were never accounting for the OCI equity changes. So now you're moving from a one standard to a totally different standard altogether. And similarly, you can notice that in this case as well, when you're moving from a signal influence to a passive investor, you're moving from one different standard to another. When you're looking into SI to SI, or you're looking at a case of control to SI, in those particular cases, what is happening, the overall concept of the standard is still the same. And in this particular case, you can say that since you are disposing a certain percentage, so only a proportionate percentage is to be removed, because the essence of accounting under 28 and the essence of accounting under Index 110 is still the same. So because of the disposal, you're only pushing out the excess money, which is not yet, which has already been sold into the retained earnings of the P&L. And in this case, you can see that there is a further acquisition. So in this case, you can't push out something from the OCI, because you still retain what you had earlier. So you can see that we are not pushing out anything. So, there's no need of remembering the chart. You can just go with the larger picture, that the essence of accounting under 28 and under Index 110 is same. So when you're going to make a change which results in the same essence of accounting, you're going to push a pro rata figure from the OCI. And if you're going to move from one standard to another, which has got a total different essence of accounting, you're moving from 28, or you're moving from 110 to 109, or vice versa, then it's a complete change in the essence of accounting. The full amount in the OCI is going to be transferred in the retained earnings or in the P&L, as the case might be. So just remember that what is the essence of accounting? 28 and 110 has got the same essence. But as far as the concept of 109 is got, it has got a different essence of accounting. Therefore, the concept of pushing 100% or the concept of pro rata arises. I hope I am pretty clear on what I said. Clear, Koshki? Wonderful indeed. I guess others also got pretty much clear on the agenda. Right, so this was on the agenda in terms of the fifth issue that was regarding the changes in the ownership interest in various permutation combinations. Now, I want to spend a little time, friends, with you on indas 27 now. Because indas 27, we've got hardly any questions which have ever come in the exams, but I think still we need to give you some basic clarity at least, so that we get, at least some basic understanding. So I'm going to spend the last 10, 12 minutes on my indas 27 with you. So let me, I think, first of all, come to the study material with you on indas 27. Now you can comfortably revise your 28. All the 5 agendas in terms of the standard is done with you. So I am now coming to the standard indas 27 with you. From an examination perspective, there are not any questions I remember till date which have come in the exam. And it's a very simple standard from the examination perspective. Now, let me, I think, first of all, clarify one thing, which people generally get a little confusion, and I think I'd like to clarify something. When you look at the concept of indas 27, it talks of the concept of what we call separate financial statements. Now, let me tell you one thing, that as a company, let's say A Limited, this company has got an investment in B Limited. It has got investment neither in a subsidiary, neither in a joint venture, neither in an associate. A company A Limited has got no investments in subsidiary, associate, or a joint venture. The only investment he's got is investment in B. That is a passive investment. In this particular case, indas 27 does not apply to this company. He will be making financial statements which you can technically call stand-alone financial statements. You can technically say that A is going to make what we call stand-alone financial statements. Sometimes we also call them as individual financial statements. We also call them as individual financial statements. Now, let's imagine another example. There is a company A Limited and it has got investment in B Limited. Now, this investment is either a subsidiary or a JV or an associate, but it's not a case of passive investment. But not a case of passive investment, though he may have passive investments as well. But A has got investment in B, so either it is a subsidiary or a JV or an associate, then indas 27 would apply to A. A will be making a separate financial statements, and it is also going to make consolidated financial statements depending upon the type of relationship. So A Limited is going to present a separate financial statements and then consolidate the subsidiary as per 110, consolidate the JV as per 28, or associate as per 28 as well. So the concept of separate financial statements applies to companies which has got investment in a subsidiary, associate, or a JV. If you don't have investments in these 3 kind of relationship, then separate financial statements do not apply. Now, what does the indas 27 actually tell me? Indas 27 tells me something very interesting indeed. That if you've got investment in subsidiary, associate, or JV, in this particular case, it says you've got a choice as per indas 27. That you can take the investment at cost or you can take these investments at a fair value. Now, when you go to consider the investments at a fair value, this will bring you under the purview of Ind AS 109. This will bring you under the purview of Ind AS 109. So the company would either apply a cost method or they would apply a fair value, which means you will again get a choice of FPTPL or a choice of FPTOCI, which is no recycling. So indas 109 throws these investments out from the scope of the standard, but then indas 27 brings them back with a choice. That the company can either choose to apply a cost method for these investments, or it can choose a fair value, which is either a fair value through P&L or a fair value through OCI. Also, if you're going to measure these investments at cost, then there will be an impairment testing which will be done under IS 36. I gave you this inputs earlier in financial instrument standard as well, that if a company is got an investment in related parties, then since it is covered under 27 under cost method, then impairment testing is covered under IS 36 and not India's 109. But if these investments are taken at a fair value, then the concept of impairment does not apply. This is one. So these investments will be measured according to these principles of measurement. Further, now let's take it further. Remember that there were a couple of situations in terms of 110 and in terms of Index 28, where a company is exempted from making a consolidated financials. Now, the question is that when you are exempted or you are given a mandatory exception, whatever, there is an exemption or there is an exception. Let's talk about two cases now. Let's talk about the two cases now wonderfully, because I want to give you the exception to the measurement principles of 27. Now, imagine a company applied Index 110 and it got classified as an investment entity. The company was supposed to be applying Index 110. It got classified as an investment entity and it is exempt from making any consolidated financial statements. Will it be still covered to make separate financial statements? Yes. But now, interestingly, this company, while making these separate financial statements, cannot apply measuring the investment at cost or a fair value. The choice vanishes. If you remember, Index 110 very clearly says that this investment in the separate financial statements has to be taken at FPTPL only. You will not be able to get a choice in terms of cost or you can say a fair value approach. So which means the concept of the cost or fair value is available in those cases when a company is preparing both an SFS and a CFS. The moment the company gets the status of an investment entity under Index 110, and it is not required on a mandatory basis to make a CFS, but would still be required to make an SFS, the investment value will be taken at FPTBL only. It cannot take it at cost. It cannot take it at FPT OCI NR. Similarly, if you recall the concept in terms of Ind AS 28, you will remember that in terms of Index 28, when you were looking at a company which is a venture capital organization or a mutual fund or a unit trust or any other similar kind of entity, then by virtue of the para number 18 and the para number 19, you may get an exemption, and which can become mandatory as well, or you may just get an exemption. And in those particular cases also, the consolidated financial statements equity method is not applicable to them. And still they would be presenting the statement in the separate financial statements. So separate financial statements would apply. But here again, you will not get a choice of a cost and a fair value. You have to mandatorily take the investment at FPTPL only. So I guess I've made myself very clear. So there are 2-3 agendas which I have given you. I have given you the first input in terms of Index 27, that this standard would apply when a company has got investment in a subsidiary, associate, or a JV. Irrespective whether you are exempted under 110 or under 28 in terms of making consolidated financial statements, SFS would still apply. So company which has got a passive investment would not apply Index 27. They will make separate or what's standalone or what you call the individual financial statements. But if a company has got investment in a subsidiary, asset, or a JV, in those particular cases, yes, the Index 27 applies, which gives you a choice of measurement of these investments in the separate financials. Either you apply a cost method, which is subject to impairment testing under Ind AS 36. I wrote IS 36 as good as Ind AS 36. So you need to apply Ind AS 36 for impairment testing. Or you choose a fair value approach as per Index 109, either apply FPTVL or FPT OCI NR. But then no impairment testing would apply. So this is a choice when you get. But when does this choice actually get restricted? When a company is not consolidating under Index 110 because it is an investment entity, or a company is not consolidating because it is a venture capital organization or a mutual fund or unit trust or similar entity, then either you are being mandated not to consolidate or you are being given an option not to consolidate. Irrespective, these companies, when you reflect these investments, then you will reflect the investment in your subsidiaries and associates and JVs by only measuring them at FVTPL. You will not get the concept of cost method, and you will not get the concept of the FPT OCI as well. So this is, you can see now in the study mat, there is a wonderful illustration which is given. And, they've given a good example of whatever understanding I've given you, where you can see that there is a parent company which has got two subsidiaries and it has got one associate and an investment entity D. And these companies have got further subsidiaries as well. And we are looking at the application of, Index 27 or consolidations to this. Now, parent company in this case will consolidate A. And as far as B is concerned, it says it got an exemption from consolidating. So parent company would be consolidating A also, B also, and it will be consolidating the associate also, and it will be consolidating the investment entity also. The parent will be consolidating everything. But if you look at subsidiary A, it will consolidate P. Subsidiary B will not consolidate Q. And associate C would, consolidate R. And then entity D would not consolidate S. But you just need to be clear that irrespective, if the consolidation exemption is available under 110, or you can say the consolidation exemption exception is available under 28, then also separate financial statements would trigger and the investments will be taken at FVTPL. So the clarity is given in this, in which cases SFS would apply. But I've given you a little step further that in terms of, if you're making SFS, which cases you get a cost fair value choice, which cases you necessarily need to apply FVTPL. So this is the basic inputs I have given you on this particular standard. If you look at from the examination point of view, there has been no questions, I guess, so far, what I remember. Maybe there was one small little question which came, I think, last attempt something. I don't remember it very clear. But otherwise, there has not been much questions on this area. But still, we have to give you some, at least basic exposure on this particular standard. Right, friends. So I think that brings us to the end of the journey in terms of Index 28 as well as Index 27. So let's see if you've got any questions further to ask you. Okay, I think there's a particular question. Koshki said, can you tell the impairment testing thing again? Okay, I'll put that again. Well, in terms of the impairment testing, let me just go back to this and show you. If you're looking at the impairment testing, the moment you apply Index 27 and choose a cost method, since it is a financial asset, but it is not covered under Index 109, impairment testing would apply, but it would be covered under Index 36. Index 36 per se applies to impairment testing for non-financial assets. But this becomes an exception where it is a financial asset, but still the impairment testing gets covered under 36 because investment in related party is being scoped out of 109. Since it has been scoped out of 109, then all these investments are covered under 27. And if you choose a cost method, impairment testing is done. But if you choose a fair value approach, then you're covered under 109, and equity investments under 109 don't require any kind of impairment testing, irrespective FPTPL or FEDN's OCI, anything applies, right? Koshi, in parent number 17, also no choice. That's right, absolutely. You can say that because even when you're considering that, yes, there is going to be no choice in that particular case as well. Because the moment you get exceptions, the moment you get exemptions, and you're mandatorily required to follow an FPTPL, you can say, yes, the choice is gone. Right, friends. So I think that answers the question, I guess. And let's see if you're getting any further questions on your side. Okay, nothing so far. Right, friends. So I think we are done with this particular standard with you. So I think that's all. If there are further questions, I'll just check this again. Otherwise, time to bid a goodbye on that. Please do revise the standard from the study material. Also practice the questions which have come in the examinations and the RTPs and all. And if you want a little more extensive things, you can maybe refer the education material. There has been an education material on 27, 28 both, but I think 27 would get a little too much. But if you want, you can capture a few illustrations on 28, especially on the area of changes in the ownership interest. Right, friends. So I think time to bid goodbye, friends, on that. So I take leave from you on that end. I think no further questions coming in. Thank you. Bye-bye and take care.